Inox Wind is up about 5.75%, humongous volumes. Shipping Corporation, I think numbers, 4.5 higher, 270. Mangalam was talking about Jubilant Food. I think there is an upgrade from Jefferies as well, 617 on Jubilant Food. Aavas Financiers, actually there are two microfinance companies. Aavas Financiers is up 7%. There is a deal brewing there. And the other one, of course, is Credit Access, where there are reports this morning which suggest that, the foreign owner is actually looking to get out. So that's the stock's down about 1%. Credit Access, of course, in terms of the MFI space, is rated as, is seen as the highest quality lender in that in the microfinance area. Safari is up 4.5%. That's a luggage maker, 2410. Big volumes at this point. For this time of the day, actually. Coromandel is up about 2%. Graphite is up about 3%. Graphite India, 536. PNC Infra is coming up with a 7% gain, 480. There's more stuff. Ola Electric is up 12% now. So keep an eye on. Actually, we should put up the Ola Electric stock. There's a lot of interest, huge volumes as well, right at the bottom of the screen. It's the largest volume-led gainer. And of course, I think as Nigel mentioned, a lot of the Adani Group stocks are under pressure. Enterprises, Ports, Power, Green, they're all down between 3 and 5-6%. Adani Wilmar, Adani Total Gas down 4-5% as well. So this is broadly how we are starting up.
Just one word on Voltas, Prashant. The reason that the stock is reacting so much on the upside is the last few days, the stock actually had corrected close to around 6%. It actually underperformed the market going into these numbers. And by the look of it, the sense is that they could have gained some market share in the last quarter, on a quarter-to-quarter basis as well, roughly 200-250 basis points. I'm reading a sales note out there. So commentary on pricing will be important. Sustenance of these kind of margins as well as inventory situation. That seems to be the stock of the morning after those numbers.
Absolutely. And very large, 2 million shares also on the NSE. So this is looking pretty solid out there. Well, let's bring in Rajiv Batra. He's, of course, with Joe. Okay, I think Rajiv will be with us in just a bit. Maybe just a couple of more names before we take it forward. Bharat Dynamics, BDL, is down 8%. That's the defense company, a PSU defense company, 1318 on Bharat Dynamics. And of course, it's come off quite sharply from the highs. The high in the month of July, actually, this is the all-time high, as well as about 1720. From 1720 to 1318. About 15 trading sessions, not even 15 trading sessions. So that is a very sharp knock that we are seeing here. Lemon Tree has not been able to recover. It's basically a waterfall decline from 150 levels to 116. The first quarter numbers, of course, were a bit of a miss. But, the decline started much before that. The all-time high on Lemon Tree was about 160 rupees. So that's lost quite a bit. And there is IIFL this morning, which is also down about 2.75%. Stocks at about 411, 412 or so. So this is some of what is going on across on the market front. Rajiv Batra is with us. He's of course with JP Morgan. Rajiv, great to have you with us here. Thank you very much for your time. Appreciate it. Prashant this side. I'm looking at what your note says, and I'm sort of just read out this portion of for our viewers, because this is the operative part. What you're saying is, we worry that such rapid market declines, and you're referring, of course, to what we saw in the Japanese market and, all of the volatility last week. You say, and I quote, we worry that such rapid market declines often lead to unexpected ruptures in the market, from spillovers and cross-asset volatility, dispersion, and private markets to at least margin calls. And any bounds here may not sustain far until we arrive at a new market structure equilibrium. Is that the operative part, Rajiv? Is that kind of sort of in one line the view that you're sort of telling your clients when you're speaking with them?
Exactly. That's what we have been expecting for the second half. So when we wrote the outlook note start of the year, we said to our investor that first half, you will be able to make a good set of a return. Market may operates in a Goldilocks period. And hence, we have seen Asia ex-Japan index operated in the base case and the bull case territory for us. But we knew as we head into the second half, if the positionings are overcrowded and going into one of the biggest event of the year, US election, there could be some round of uncertainty, even in terms of if monetary policy regime is also shifting from tightening to easing. That's what we exactly saw over the last 1 month, where middle of July, due to the tech earnings season weakness in the US, we saw the first bout of the volatility. And now Last week, the second bout of volatility hit due to the carry trade unwinding and the rising US recession risk. And we believe this bout of volatility may need to continue because of either the geopolitical uncertainty, the activity data which is weakening in the US, and maybe even because of some exaggerated or overcrowded positioning in the equity markets too.
So how do you suggest one play this extended period of volatility up until at least the events get out of the way, Rajiv? You know, what are your sector calls and what are you suggesting investors do to protect themselves from such sort of volatility?
So the prudent measures would be, rather than taking the clear country or a sector call, people should take call within the sectors and more on the factors or the style basis. So the styles or factors which have not done well so far this year, as an example, low walls, quality, or even defensiveness, that's what should be the key part of your portfolio, because in the next month or two, when the volatility swings will keep on happening, the low wall or quality exposures or even a marginal sustainable growth exposure will help you safeguard your portfolio and prep you up for a possible year-end rally also. But till then, capital protection is utmost important.
All right. Hi, Rajiv. Good morning and good to see you, Vin. You know, the big story here for most Indian investors is we are cheering the decoupling. The globe will fall, but if it falls, we'll fall less. And if it goes up, we'll go up more. That's what we believe, at least. But at current valuations, what's your view on the Indian markets? You know, a lot of challenges have come about. We didn't get an absolute majority of the ruling government. We got a tweaking in capital gains, but still the market's just 2% away from fresh all-time highs. Your comment on this?
No, so definitely, if you look at the trade over the last month or so, when the global volatility is happening, domestics are faring far bit better. So be it India, be it Southeast Asia, ASEAN market, or even if China, the more you have a domestic exposure, the better off you are. And this is the reason why when markets are declining, these domestic exposures are outperforming, even based on the feedback from investors whom I'm been talking and traveling and meeting last 5 weeks, have been very clear that they need to increase their exposure substantially towards the domestic heaven, that is more South Asia part of the world compared to the North Asia, because of the gyration they are expected to see in the economic data prints in the North Asia side. Coming back to the India, yes, definitely valuations are expensive. And after a bout of inflows, which we have seen post-election result, there is a merit that market could take a breather before again start inching up higher. So tailwinds, positive tailwinds which were there in place, like earnings, budget, or even continuity of policy, that tailwinds are now coming to an end and headwinds are approaching. So seasonally, if we see September 8 out of the 10 years is a weaker month for India. Besides that, earnings, if you will look this quarter, have been lackluster or sideline, in line with what everyone expected. And then most obviously, state elections are approaching, which can make people think or have a deja vu of the last year, where going into the state election, markets were on the sideline. So for India, relative terms, we could be still an outperformer, keep on doing well. But absolute term, we will be in a range-bound state.
Speaking about range-bound, you know, there is no dip in Siemens, which is not bought. In fact, this stock opened mildly in the red. Vamakshi did tell us that there was weakness in their mobility business margins, and that dip has been swiftly bought into. The stocks recovered about 3.5–4% from the lows, stock back above that 7,000 mark, and has moved higher. It's already seen a big move, almost 75% from the start of this year. Not particularly comfortable when it comes to valuations as well, but maybe the street is eyeing some more in Siemens going on from here on, and that explains why the dip on that stock has been bought into.
No, absolutely, and you know, there's a fair bit of interest in some of these names that we have been talking about, and that continues. Sun TV is down. Sun TV is down 8%.
Yeah.
So stocks at about what, 842? That's a large cut that we're talking about. You know, it closed at about 916, 917, at about 842. at this point in time. So it's basically been pushing lower from the word go, although it's just still about 10 minutes or so as far as market open is concerned.
The problems are on the margins. The margins, 500 basis points contraction on a year-on-year as well as on a sequential basis. Top line was okay, but I guess that's one of the reasons. It's not as cheap as it was. I think 2.5 months ago, it was at around 650 rupees odd. So at that point of time, the core business, I think you were getting it at around 4 times EV on EBITDA. X of the cash, X of the IPL franchise, if you put a value to that. So now it's not as cheap. So I think the room for, in terms of that valuation comfort went out. I guess that's why the stock is getting pulled back.
Room for disappointment is zero.
Very, very minimal.
So, I mean...
But some of these Adani Group stocks actually have come off the low point of the day. Adani, some of these Adani Total Gas as well, it's come off a little bit from the low point of the day. I think Adani Enterprises as well. So, that's the frontline name. Let's pull up Adani Ports as well. So, some bit of recovery from the day's low. Adani Energy Solutions, we had highlighted that there was a big difference, between both the rates. So recovery on one of those groups that are in focus today.
I think, that's absolutely right. Astral is another one I want to highlight. Again, one of these names, again, first quarter numbers were nothing great. We spoke with the management on Friday morning from 2,500 stocks down to 1,950 or so very quickly. Last 10 or 15 trading sessions is more like it. So there is, price damage occurring on a wide wide swath of stocks. Midhani, which is Mishra Dhatu, I think there was massive compression in margins here. So high was 540, 550, stocks at about 420 now. Although today, from the day's lowest point, is actually trying to come back up a little bit. Zydus Life is another one, has had a one-way move higher. But it's kind of I think, faltering a little bit in today's trading session. For the year, it's up 80%, Zydus Life.
I think even Stovecraft, we had the management. When you had TTK Prestige, it didn't grow, and Butterfly Gandhimati actually gave a degrowth. They grew a little bit, and they're promising better times ahead. They've disappointed in the past, but for the time being, Stovecraft is up close to around 6%. So the street will eye delivery, because actually the stock is still, I think, not made the high that it made when it post-listing. So it's still a distance away from there.
Absolutely. It's been one of those sort of underperformers in a market where there's not very many underperformers, the outperformers. Rajiv, from a flow perspective, right? What does all of this, the spike in global volatility, etc., mean for India? The market here in India has been driven almost entirely by local investors, right? And that is the bid under this market. Over the last 3-4 shocks, some mini, some slightly more than mini, the election, the tax change, the recent yen episode, market from high to low, the Nifty fell just 4.5% in local currency terms, the least amongst major markets. The question, though, is, does this delay, when foreign investors come back into this market, what's happening globally? What's your sense?
Definitely, local investors are not going to be an issue. We continue to expect domestic keeps on buying into the equity market, looking at their balance sheet exposure, which are still quite low on the equity exposure side. So domestic inflows we expected to continue through SIP, lump sum, and NFO kind of a route. Talking about the global investors, it was very interesting during the budget time while I was in the US. Investors were disappointed to see that during the budget day, there was not a deep correction, because everyone was looking for correction to buy, was planning to buy into this correction or a dip of a budget if that would have happened. So what foreign investors are looking like, if any dip comes in India at a single stock level or at a sector level where the value is emerging, they will be buyer into that. And if you would have seen since election and take last 1.5 week out, there was a period we got close to $9 to $10 billion of inflow in Indian equities. That is an evidence that foreign investors are more than happy to cut down their underweights on India, go towards a neutral kind of a territory, but want to pick up sectors or stocks where value has started emerging. So that provides another set of a confidence to the investors that even in case if India is declining, a lot of money is still waiting on the sideline to enter into Indian equity markets.
All right, take that point. A lot of money is waiting on the sidelines to enter the Indian equity markets, and that seems to be the order of today's trading session so far as well. 15 minutes into opening now, we have the early rates which have settled in. The Nifty has actually recovered a fair bit from the lows, and the mid-cap index, that's really been the star of the morning so far. At one point, it was down by almost 0.75%, now down by just about 100 points, a tenth of each. And the story would also be clearer if you look at just the advanced decline lines of the last 15 minutes or so. When we started out we had nearly 3 stocks declining for every stock which was advancing. That moved on to closer to 2, and now those lines have come perilously close to each other. Just about 1,000 stocks advancing for about 1,300 stocks which are declining. So if the mid-cap index does recover, that tells you that maybe we're out of worries. A lot of these individual stocks surging. You have Trent, which has now made the highs of the morning. Apart from that, we're seeing increased traction on Coromandel. It was, I think, Sudarshan's 9 a.m. pick. So just pull up Coromandel International as well. And then you have names like Granules, Metropolis. The paint space, that's done well too. We had Berger Paints report numbers on Friday telling you that they saw the maximum amount of market share gain in a quarter this time around in the first quarter. That stock's done extremely well. Asian Paints too is out of the woods now, currently in the green. A lot of these cash market stocks seeing bigger moves as well. Real estate sector, we have Macrotech Developers up around 5%, Parag Milk up around 5%, Allied Blenders up around 5% as well. So we'll keep an eye out on the broader markets. Now seems like we've seen some bit of recovery from the lows, the broader markets recovering faster. Let's focus on ABB, which reported a strong set of numbers in the first quarter, CY24 as well. EBITDA margins coming in at a record high, expanded by nearly 526 basis points. And there have been a big surge in the profitability as well. Our colleague Vamakshi caught up with the management and began by asking on if they continue to hold on to the margin guidance that they'd given at the start of this year. Listen in.
Rightly captured that 300 basis points come from the internal efficiencies what we have derived so far. But of course, you should understand that this internal efficiencies also is driven by the volume growth which we are seeing in the market, right? And so that's something which is very important for us to sustain. So, and if that particular margin, the margin, if you want to sustain, it's important that we have the volume growth also supporting it. So that's number one. And number two is, I think productivity is definitely a topic which is very important for every business. And they look at all options where they could be productive and improve their efficiencies in this particular journey, right? So I think it's a route of discovery every day. And so as and when people try to find out how they could unlock this particular value, right, to the shareholders and to the bottom line of the numbers, I think it should pretty much work out. But the question is there an end to this, or is there something which will deter this? I think it all depends on how the situation develops. And as the volume supports, I think the journey of discovery still continues.
Well, absolutely. And just a follow-up question on the margins. Now, of course, you have been importing tech, and that is under the normal course of business. But what is the kind of royalty fees that you're paying as a percentage of your sales? Has it increased? Because we're seeing a rise in the other expenses. And, I'm just trying to understand here, what portion of this improvement in margins is being driven by localization as well as the pricing power?
I think pricing power is definitely on the external side of it. It's basically how the customers are willing to pay for the quality of the products which are the services what we're providing. And we have seen this actually going through a transformation journey in the market. So that's why we could see that also reflecting in the margins. That means people are able to pay and are willing to pay for the quality and the technology what ABB is able to provide. That's number one, right? And the number two is regarding how can we make sure that this actually is held together is again depending on the demand situation which is developing in the market. And we are sort of seeing a very positive view of it at this point of time, right? So with the elections and the budgets all done, so we have a stable government in the at the center. So I think it's only the capex cycle which has to follow, which we are all expecting. So it's sort of unfold in the coming times. And coming to the royalty part of it, we pay 2.89 to 3% as royalty, 1% as for the brand royalty, which is called as trademark fees. So this is basically what we pay on account of royalty and trademark.
All right, sure. Thank you so much for that. And now coming to Mr. Sharma, ordering activity in the first quarter was rather muted, and of course it could be expected mainly on account of the elections as well as the budget that just got concluded. So would just like to ask you about the outlook going ahead. How is the pipeline shaping up now in the 4 segments that you operate in, and what is the conversion rate that you're expecting?
Well, thanks for having us. Well, as far as our 4 verticals are concerned, these 4 verticals have 18 business divisions. And our sense of having come out of election and the budget period is that the pipeline ahead is quite robust for us. And we operate with 18 division and 23 market segments. So overall pipeline for us, where our interest lies, it looks good at the moment.
All right, and order inflow in the first quarter was supported by large orders. So is this trend expected to continue going forward in the year as well? And do you expect the mix of nearly 40 to 45% of large orders in the overall order book to continue, or is there a change expected here?
Well, we do expect it because as far as the flow business is concerned, which we call as the fast-moving industrial goods, which are mainly in our electrification and motion business, which constitutes about 75% of our business. We do expect continuous strong flows there going forward. In the market segments, we see good activity. As far as the large projects are concerned, they come from the core sectors or major spenders like railways, metros, and they are not the ones which repeat every month, but then they keep coming every quarter or two.
All right, got that. And let's also talk about exports because they've seen a good growth of almost 39% this time around. And this is despite the geopolitical risk as well as the trade disruptions that we're seeing. So is this good growth in exports expected to continue? And it currently accounts nearly 10% of your overall share. So is this expected to rise further?
So our primary focus as a multinational corporation dedicated for India is Indian market, domestic market, and that's where we see maximum growth coming for us going forward, and we see the activity quite in favor of our portfolio. Now, our operations in the country, as I said, we have 25 factories and a fair bit of localization. They're increasingly becoming attractive factories for our global businesses, and they're increasingly giving the allocations of different markets to be served out of India. So we see this is a long-term story for us, and we continue to gain out of it. So different businesses have the mandate to export to different markets as allocated by our global businesses, and we see this trend will continue.
Sure. And, one last question to Mr. Sridhar, actually. So I know you don't give forward-looking guidance, but, revenue growth was definitely muted in first quarter as compared to, in the second quarter as compared to the first quarter and the previous year. But what would the top-line growth look like this year in comparison to the growth that we saw last year? Is it going to be at similar levels, or is the growth rate expected to be better than last year?
So I think when we look at 23, all right, you are comparing with 22, and 22, of course, comes strongly from the COVID period of 21 as well. I think the growth rate was very much faster and higher when you see 23 to 22. But when you look from 24 to 23, you're looking at a base which is very constant, which is 23 was pretty much very solid in that way. So in the 24, of course, we'll have growth. And I think we have been growing at a good double-digit number at this point of time, and we will definitely maintain that. I think if I want to allude on the topic of backlog, so our backlog, which is roughly around about 9,300 crores, is consisting of both large orders, which have an execution time cycle of a minimum of 15 to 18 months, and then you also have almost 55% coming from the short cycle orders, which have an execution time of 6 to 9 months. I think this has a pattern to convert itself, and we are sure that this will get sort of executed in the periods to come. And our aim is to make sure that we are there with a double-digit growth quarter on quarter. That's what we have been looking for. So this quarter, coming to this quarter, yes, we missed roughly around 150 to 200 crores of revenue. That's more because the economy was waiting for some important decisions followed by the budget as well. So that made the businesses to wait for an outcome of it, and therefore it was a more conscious call from the businesses to make sure that they are aligned with the macro and topics to be there. So I think we see this as a momentary shift, and we are making sure that every effort is done to catch up with this particular slippage which happened in the second quarter.
All right. Thank you so much, gentlemen, for that conversation. That really cleared the air about the margins as well as the order outlook. Thank you so much.
Thank you. Thank you.
All right, that was the management of ABB, the stock down about 1.5%. Let's talk about another one, which is seeing a big up move. That's Inox Wind. It was a strong quarter for the company. sharp expansion in the EBITDA margin due to superior sales mix. Devansh Jain, who's the ED of Inox, joins in now to give us more on the first quarter performance, but more importantly, what the year ahead looks like. Thanks a lot for joining in. First up, if you could, confirm whether this 140 megawatts of execution run rate continues through this year. What's the outlook out here? And margins as well. I mean, very strong, a little about 21%. Does that sustain? What are the levers here?
Hi, good morning. Pleasure to be back on CNBC. So as you know, Q1 was the highest financial performance in the history of Inox Wind. Our revenue was up about 85% and EBITDA was up almost 350%. Coming to your question on margins, look, we've guided for about 15 to 16% margin for the entire financial year. And obviously, there could be a slight upside to that as we move forward. But having said that, we continue to maintain our guidance at 15 to 16%. This quarter has been close to 21%, but I think in the course of the full financial year, we should be closer to the numbers I spoke about. With respect to the 140 megawatts you talk about, as I think is well known in the industry, Q1 is probably the lowest, Q1 and Q2, given that it's onset of monsoon, and Q3 and Q4 typically are the highest. So I would tend to think that Q3 and Q4 would be far larger than our Q1 numbers.
All right. Hi, Devansh. First of all, congratulations on a good set of numbers. You have been walking the talk, so that's good news from an investor's perspective. A couple of details I wanted. Are you facing some logistical issues? Because that's what some part of the street believes. Could you clarify on that front? And what is the breakup? This 800 megawatt is well and truly on, 300 in the first half and 500 in the second half. Give us some more details on that, on the execution.
Look, I'm not sure where this logistical issue question has come up from. We face no constraints whatsoever. Business is on track. We have publicly stated our vision to be a 2 gigawatt company in the near future. And I think we should be achieving that sooner than what is expected by most of the street. We've also gone on record to state that there is a fairly large upside to our FY26 numbers. While we've not upgraded the 800 and 1200 megawatts targets which we've set out for ourselves for 25 and 26, I think the order book in itself speaks volumes, and our current run rate of execution and profitability gives a fair amount of hint of where we are headed. With respect to your question of 300 and 500, look, we've stated our guidance of being an 800 megawatt supply or execution company this financial year. And I think we are very well on track to achieve that.
Got it, Devansh. So 15-16% margins, 800 and 1200 megawatt in the next couple of years, and no logistical issues. Part of the investor community had that query, so that's why I put it across to you. Let's get a couple of more details. Your current order book is around 2.9 gigawatt. Over what span do you see this getting executed? And also, if you could give us a sense of the commercial and industrial demand. Is that strong? If yes, should we be looking forward to some more announcements on closure of some orders?
Look, the 2.9 gigawatt order book, again, is the largest we've ever had in our history. Typically, this is something which we would execute in about 2 years. You typically get orders, private sector gives you orders which typically give you an execution timeline of about 12 months. PSUs typically give you orders where the peak execution cycle is about 24 months. And then you've got retail and smaller C&I, which would be about 6 to 9 months, within which I would tend to believe the 2.9 would be executed in the next 24 months. Again, I did mention that we are gunning to be a 2 gigawatt company in the near future. But again, depending on how fast and how large the Indian market is, we could see a much larger play out as we move forward. As we've announced in this quarter, we've already started setting up a larger nacelle manufacturing facility in Ahmedabad in Gujarat, which would enhance our ability to manufacture beyond 2.5 gigawatts of nacelles. So we're gearing up for the future. With respect to the CNI order book, I think we're seeing tremendous momentum, driven by multiple reasons. Primarily, of course, is that renewables is the cheapest source of power. Second, I think a lot of exporters, given that you now have CBAM coming up in Europe and eventually carbon taxes coming up in different parts of the world, particularly the developed countries, you would need green credentials and renewable power. And what's better than renewable energy? Moreover, a lot of the larger corporates are setting up their own platforms. So it's a win-win. They raise equity there. They create value on that front. The operating entities themselves, without any capex, gain significantly. We will be announcing a much larger play even within the Inox GFL group for our own captive renewable energy requirements. But I think the CNI market is booming.
Right.
We've announced about 600...
Devansh, just a quick word. In terms of acquisitions, I mean, Suzlon recently announced an acquisition on the OMS side. Will a lot of this ambition be via sort of buying companies? I mean, are there enough players in the market? I mean, that Suzlon, we spoke with the management of Suzlon. It was it was on the OMS side, and it was pretty small as compared to Suzlon's size. I mean, so just give us a sense of that. How much of this ambition is going to be via acquiring companies out there?
Look, what we're talking about is at Inox Wind, which is a manufacturing company supplying turbines. And on the CNI side, you're really supplying newer and newer turbines to take care of the incremental power requirements or the existing power requirements of thermal, which are being replaced by renewable energy. O&M is a different piece altogether. That's something, as you may be well aware, we probably have the only...
Devan, I was just using that as an example. Are there, on the manufacturing side, will there be sort of M&A strategy? Are you looking at opportunities?
Well, we are looking at opportunities, but that's more on the O&M side, not on the manufacturing side.
Okay.
I think at Inox Wind, we have the lowest cost structure. So I don't think there's anybody to acquire out there in terms of who could be value accretive to Inox Wind. But
so
yes,
just two-part question. Right.
A lot of acquisitions on the Inox Green side of things, where we expand our O&M portfolio.
All right. So just two-part question then. One would be on the acquisition itself. What is the size that you're targeting, if any timelines, etc.? That's point number one. And secondly, you did briefly speak about CNI. If you could give us a sense of how big the market is, how big do you expect to be in this over the next couple of years?
I'm sorry, I could not hear you. I think there's a cross connection. Could you repeat?
Yeah. So can you hear me now?
Hello?
All right. You want to try this?
Yes. Devansh, are we audible?
Yes, yes.
All right. I think Mangalam has a query, but he'll get back with that one. I wanted to ask you about the interest cost. You know, on a quarterly basis, for the last few quarters, it's been in that vicinity of around 56 to around 65 crores per quarter. Now, for the past quarter, your PAT number itself was close to 50 crores. But as you'll have put in some money and you're virtually debt-free, if I understand correctly, that interest cost should come down on a quarterly basis. So from this 55, 65 crores per quarter, what does the interest cost come down to from quarter two onwards?
Look, I think we did mention we are now a net cash entity.
Yes.
And what's also been publicly stated is from Q2, our net finance costs should be negligible. So yes, you see a large chunk, you see 50, 58 crores over the past 2 quarters, but a lot of it also had to do with a lot of the repayments we were doing and a lot of one-time charges. I think for the full financial year, we've guided for net finance costs to be in the vicinity of 60 to 75 crores, which would entail a saving of almost 200 crores from the previous financial year. And given the fact that we are net cash now, I think this is behind us. I don't think finance cost is something which is going to be anything which is going to be really key. It's really going to add to the bottom line going forward.
Yeah, that's the reason I ask you that, because as of now, PAT as well as interest costs are almost the same. So that interest cost comes down drastically,
I think
then that will get added to the profitability.
I think that should virtually double, given that we've mentioned that interest costs from the next quarter should be negligible.
All right. Final question then. I hope you can hear me now. Is because on the CNI business itself, you said that on O&M, you're looking at some opportunities. So if you could give us a sense of the size and the timeline that you're looking at in terms of any sort of inorganic plans there. And secondly, on CNI, how big are you planning to be here in the next, say, 1 to 2 years?
Look, first and foremost, on the O&M opportunity in Inox Green, we had recently raised about 1,050 crores, which is primary. We are evaluating multiple opportunities as we speak, but we have a very prudent capital allocation policy. We will not buy out entities just them out or at numbers which make no commercial sense to us. We are looking at a very accretive business model under Inox Green, which is beyond just servicing turbines. We'll talk about that more as we in the coming months. But I think we are evaluating multiple opportunities. That's all that I can say at this point in time. With respect to the CNI market,
yeah.
Look, I think, we're not married to CNI or retail or PSU or SECI tenders for that matter. I mean, at the end of the day, the Inox Wind, we're supplying turbines. Having said that, I think the CNI market is just getting larger and larger. So maybe a year ago, our PSU market or order book was almost 70% PSUs. Today it's down about 35%. We've strategically also diversified across multiple customers. We have 7-8 very large customers. We intend to add about 3 or 4 very large customers in the near future. And I think I would tend to believe CNI should be about 60 to 70% of the market as we move forward.
Okay, all right. Commercial and industrial, 60 to 70% of the market opportunity out there. But as you say, of course, you go where the opportunity is. Thank you very much, Devant, for joining us. It's a pleasure. And good luck to you and your team as you continue to execute well. We'll take a quick commercial break here. I think the market's down, back down again, actually. So we're down about 140 points, which basically means we're at the day's low. And there is a lot happening. Market breadth is again widened. I mean, the gap between what's up and what's down, the number of stocks up and down, that's again widened. And there are these single stock accidents. We mentioned Sun TV earlier, but Bharat Dynamics is another one, sharp cut. I just want to add 2 or 3 more. Balkrishna Industries is down 7%. It's actually come off the lows of the day. Low was 27.50. It's at about 28.50. But it's still down 7 right now. That's Balkrishna Industries. And then look at something like a LIC, which has also come off sharply. It's down 5%. Reported numbers Thursday evening. And you heard from the management later on Friday morning. But stocks at about 1,080, down sharply. Astral, I mentioned earlier, that's another one. Fintech had a sharp up move last 2 days. That is down 5,020 right now. And Honasa, of course, which again reacting to earnings, is down about 5%. Stocks at about 451. We'll take a quick commercial break here. We'll talk more about some of these names, the market, and of course we'll get back to that story in terms of the Hindenburg report. We'll have some experts join in to weigh in. We have Jayant Gupta, former ED, SEBI, and Sanjay Asher, senior partner at Crawford, Bailey and Company, joining in with their perspective on this matter. Stay tuned. Okay, welcome back. Let's shift focus back on the sort of news story of the weekend which came out. Hindenburg Research putting out allegations against SEBI chairperson on counts of conflict of interest and with regards to Adani Group and questioned her credibility in investigating the allegations against the Adani Group. Let's get in Jayant Gupta, former ED SEBI, who is joining in right now, and we'll have more experts coming on in just a bit. We have Sanjay Asher also with us on the phone line at Crawford, Bailey and Company. Sanjay and Mr. Gupta, great to have both of you here. Thank you for your time. Mr. Gupta, in a way, kind of unprecedented kind of news. This is a slightly unprecedented news story. The allegations being made against the SEBI chairperson. but responded to very fast and in a very detailed way. Your first thoughts on this entire saga, sir?
See, I am not surprised that there are allegations, because nowadays it is the norm that when you don't like somebody, when you have something, you start maligning the character of the person. So that is the norm nowadays. So don't be surprised, it is there. Coming back to the allegations and the rebuttal by Book family, I think it's fair, and I have no doubt that there is nothing, not even iota of truth.
Okay, I think the line froze, but he was just was opening comments. Sanjay, if you were with us, you can hear me. Good morning. Thanks for joining in. You heard a portion of course, what Mr. Gupta said, and we'll go back to him. But your first thoughts on this entire matter?
I agree with Mr. Gupta completely. It is absolutely character assassination and maligning the chairperson and her husband. They have amply clarified their entire professional career history, where they were, what were they doing, which territory were they, which jurisdiction they were, etc., etc. I don't want to get into the details, but to my mind, the clarification is self-explanatory. All the allegations they have denied, and I would completely believe them, keeping in mind their professional career, their stature, the fact that the chairperson has brought out so many reforms in SEBI, and she's absolutely passionate about getting into the capital markets and reforming it, which is why she left her private job and got into the job of a SEBI chairperson. So I have no doubt about it. And I'm completely with them in as much as that, yes, in all rightfulness, they've clarified everything. So there's nothing left in it. So it is some vested interest people, maybe in the market, inside India, outside India, some competition of Adani Group or somebody who has X to grind with Adani Group perhaps could have done that. But otherwise, I don't foresee any merit in what Hindenburg reports.
Of course, I mean, what is in a way, I think, according to me, a bit unfortunate is that it's also taken a political color here in India. But Mr. Gupta, we lost you there. Please finish that point, sir.
So what I'm saying is very simple. When you look at the allegation point by point, it is something that I want to create a fiction out of nothing. And this thing is absolutely laughable, that in 2015 some investment was made when they were resident of Singapore, and in 2024 you are making an allegation that there was a co-investor Adani into that. Now I am asking you a simple question. Do you know what is going to happen tomorrow? You don't have no answer. So in 2015 you will never know that, oh, I will become chairperson of SEBI in 2023 or 2022. There will be a Hindenburg report in 2023. Oh, I will be investigating that also. Oh, it will be against Adani. Now, understand very simple thing. I ask a very simple question. When you invest money in mutual fund, do you go and ask the mutual fund, give me the details of all the 1 lakh or 2 lakh unit holders, let me do KYC of them. Oh, is there Adani is a co-investor in mutual fund, so I will not invest. And I wonder that why everybody is saying that I have not invested in Adani. What is wrong with Adani? Is Adani some black sheep or something that untouchable? There has nothing been proved against them. Everything has been exonerated. So I don't know what is the untouchability about Adani also. So the issue is very clearly, you pick up somebody, you create somebody as a monster, and then keep on building stories around that.
Right. No, absolutely. Mr. Gupta, from a... So what is... You know, Hindenburg put out another sort of list of questions, etc. I think this was early morning, late last night. I'm sure you would have seen it.
No, I haven't seen anything.
Okay. So how should the... I mean, it's kind of more of the same, but how should the... What should the response be now? I mean, does anything more needs to be done, or the clarification is out? and that's about it. What should the way forward be, Mr. Gupta? Okay, I think we lost the line there again. Sanjay, you want to take it?
Yeah, I would say if everything has been clarified by chairperson and her husband, then it is fine. Then they only have to give a simple denial. But if at all anything further allegations have been made on their investments or on their financial position, then they have to just clarify that, and they say, okay, look, we repeat what we have stated earlier, and we deny all the allegations for reasons of not traverse. But otherwise, you keep answering Hindenburg where there is no meat in there or there is no truth in the allegation does not help, because the match will go on continuously then. There has to be some full stop or some punctuation mark at some point in time.
At what point does that full stop come? I mean, we're just trying to figure out if there is any legal recourse, etc. as well, Sanjay. Just
legal recourse. Yeah. Legal recourse. If there is no truth, if there is no bit in the allegation, I would say they should file a defamation suit against Hindenburg. And there has to be some reform in terms of the likes of Hindenburg providing any report. And there has to be, government has to take action against Hindenburg, that any allegation they put, they try to destabilize the stock exchange, and stock exchange is the barometer of economy of any country. It's not only relating to SEBI or SEBI's chief. It is relating to the entire economy. There has to be some very strict disciplinary and stringent action. And they can't just keep reporting, issuing reports without factually finding out as to whether the facts which they are stating in the report are correct or incorrect. It can't be that they keep issuing report and we keep accepting it lying down. There has to be some action from our side in order to stop Hindenburg from issuing such reports and issuing further reports and further reports. It can't go on like this. So my point is that it is Mr. and Mrs. Buch should consider filing a defamation suit against Hindenburg. And two, there has to be some action from our side.
But where? Which jurisdiction?
I mean, we can consider jurisdiction whether in India, because it is affecting not only India but elsewhere as well. So they have to do this thing. Of course, the US law one will have to look at as to what the law is. But surely in India, because the report has been published in India and it is relating to her in India, so surely they can initiate defamation suit against in India.
Okay, all right. We'll leave it there for now. Thank you very much, Sanjay. Appreciate you joining in with that perspective. Mr. Gupta, if you can hear me, patchy line today, but appreciate you joining in as well. Thanks very much. Well, 120 points lower on the Nifty is what you have. 24,240. We are back, and we'll focus back on the market with some technical trades. Mitesh is going to be with us. Stay tuned.
कंपनियों और विदेशी संस्थानों के साथ आपका कौन सा ये रिश्ता पुराना है कि भारत के आर्थिक जगत के हर संस्थान के ऊपर आपका लगता निशाना है। और मैं स्पष्ट करना चाहता हूं, आज तक कांग्रेस और इन्होंने कभी किसी विदेशी कंपनी के खिलाफ कोई बयान और आंदोलन नहीं किया। हम जब विपक्ष में थे तो स्वदेशी आंदोलन हम करते थे, और जब हम सत्ता में आए तो मोदी जी की सरकार ने मेक इन इंडिया किया। अर्थात हम भारत की अपनी आर्थिक आत्मनिर्भरता को मजबूत करने के लिए प्रतिबद्ध हैं, और ये भारत के अंदर आर्थिक अराजकता लगाने के षड्यंत्र में लगे हुए हैं।
Mr. Gupta and explain what IndiGo 2.0 would mean for this company. So, as I said, it's been the market leader in India and a big market cap company as well. But company recently announced IndiGo 2.0, which means they've put out some new strategies, which includes they've now announced the business class offerings from November of this year. Second, they've announced easy to earn and burn loyalty points as well as loyalty programs. Third, they've announced 40 new international routes by end of this year. And fourth, they're going to upgrade their websites and mobile apps for further enhancement for experience for the customers. Now, what an analyst is saying, analyst believes that the business class will widen the addressable market, and loyalty program is a big plus for the company. Business class will not only improve the RASK but also improve the margins for the company going forward. And loyalty program would mean further stickiness as far as the customers are concerned. Now,
welcome back. 125 points lower on the Nifty. The mid-cap index has begun to sell off once again, down by about 0.75%. The first hour of trade trades at 10. Mitesh joins in for what he's made of the market so far and the stocks. Mitesh.
So, Mangalam, I think, it reaffirms that 24,400 is not getting captured in the short term, today's gap down, and the fact that the markets didn't try to go up and fill the gap. I think we'll take that idea of, maintaining some put options positions on the index and very likely suggesting a test of 24,000. And in case we start breaking below that, then another 200 to 50 point kind of a decline could happen. So the structure isn't turning positive with today's gap down being sustained. And on the stock side, I have one buy and one sell. Tata Power, I think, is breaking below swing lows. So keep a stop at 418. Look for a target of roughly around 396 over here. And the one which I like, I think, that's Granules, which has been running and which has been making new highs and still strong. So that is a buy with a stop at about 656 for targets of 685.
Okay, all right, Mitesh, thank you very much for that. So those are some trades coming through. PSU stocks, as we highlighted, names like Bharat Dynamics and Mishra Dhatu are seeing very sharp sell-off, 6 to 10%. Hormuz is here with what's going on. Hormuz, over to you.
It's been a trend over the last few sessions where PSUs have reported results that have mostly disappointed the street. It started off with railway stocks last week with RVNL and Ircon missing results, and we saw the impact on these stocks as well. And Bharat Dynamics today, the revenues for the quarter were down almost 36%. The profit almost eroded completely, was helped by some higher interest income. The EBITDA loss was also higher compared to the same quarter last year. So it was not a good quarter for Bharat Dynamics. Execution issues continue to hamper the operational performance of the company, and that is showing up in the stock price as well. Was down almost 15% at one point of time, has recovered slightly from the lows of the day, but still trading with losses of anywhere between 10 to 12%. Midhani is no different. Even here, the revenues were down 13%. The profit was down 70% from last year. The margins also saw contraction from 22% to sub 14% for the current quarter. So not good results for Midhani as well. That stock too is down 7 to 8%. And a trend among most of these stocks is, despite all of these stocks correcting anywhere between 20, 25, 30% from their recent record highs, they are still extremely expensive on the valuation front. Both Bharat Dynamics is down 30% after today's fall from the record high. Midhani is down 22%. But on a one-year forward basis, Bharat Dynamics still trades at 36 times compared to the 5-year average of 30. And Midhani also is trading at a one-year forward of 35 times compared to the 5-year average of around 32 times. And this is after a 20, 25, 30% correction from the record highs. So not good going for most of these PSU names, and Bharat Dynamics and Midhani are leading that fall today.
All right, thanks very much for that. So those are two names in focus, and we'll continue to do the same for other PSU names as well. But commodities are back in focus. Manisha is here with what's top of mind. Manisha, good morning.
Thank you for that, Prashant. I'm looking at the crude oil prices, where we did see the prices decline quite sharply in the last month, but that has seen a rebound. So we are off the 8-month lows, and the prices did gain 3.5% in the previous week. So after 5 weeks of decline, we've seen actually prices gain up quite strongly onto that one. It has to do with the positive economic data that we've seen come in from Europe and US. It also has to do with the more and more bets now and higher probabilities of the first rate cut coming in from the US Fed in the month of September. Apart from that, there are supply concerns from Libya's Sharara field, and there is force majeure declared there. And then there are reports suggesting that you could be looking at Iran retaliation on Israel in coming few days. Markets also are looking at the US crude inventories, which have continued to decline quite sharply, now at a 6-month lows there. So when you look at the crude oil prices for the month of July, we did see that huge range of almost $10 between 87 to 78 on the lower side. For the month of August, we picked up from 78. We did see prices go all the way to $80 in the first week of August, but currently we are holding around those 76 kind of levels there. When you look at the Indian crude demand, well, there are all reports suggesting that India will see the max or the highest energy growth marginally coming in going forward. So from 2014 at 3.23 million barrels per day of a consumption, we stand currently at 5.4 with an expectation that we could be at 6.7 by the time it's 2030. If you look at the past 1 week then, and we've seen prices gain up quite strongly there, it's not just about the crude oil prices, but coal prices are trading at a 13-week highs. We've seen 8.5% of growth in the last 1 month itself. Also, when you look at the last 1 week, the gains have been quite strong. Coal, for example, is gained up by 2%. Crude is up 5%. Strong 14% of gains is what natural gas put out. And we've seen 9% of gains coming for the gas prices in the matter of last 1 week itself. This week is going to be important because of two reasons. One, you have the Indian inflation numbers coming in today. And then you also have US inflation, US retail sales data also expected in this week. And the markets would react to that.
All right, Manisha, thank you very much for that. Well, we'll take a quick commercial break here. We are going to come back. Lata will connect with Suresh Ganpati, banking analyst at Macquarie, to focus on the first quarter earnings for the banking sector. Stay tuned.
Quite excited about IndiGo for a very long time. Look at the brokerage ratings and the target prices. Virtually everybody is having a buy or an overweight on IndiGo. Kotak, Citi, Morgan Stanley and JP Morgan. And the price range seems to be between 5,000 to 5,400, which means a potential another 15 to 25% upside even from current levels. Now, generally we've seen, when there's a big supply overhang on the stock underperform, but that's not been the case as far as IndiGo is concerned. That shows the kind of business mode this company enjoys. Gunwal, one of the big promoter entity, they've been constant sellers in the stock in the last few years now. They've done 4 tranches of stake sales from September 2022 all the way to March 2024. They've sold stakes virtually every 5 months. In fact, now they're going to sell further because the lockup is going to end. But most interesting is, ever since the first block when they sold in 2022, the stock has actually doubled in that particular period. Now expect a large block deal very soon because the lockup of 5 months is going to end in the next few days. So there will be further supply. But again, the stock has been outperforming despite the selling. Just a word on the market cap and the valuation picture now globally. IndiGo is now the second most valued company in terms of market cap, commanding a market cap of nearly $20 billion, trading at close to 20 times. Of course, Delta Airlines is the most valued company at $24 billion. The rest are Ryanair, Air China and Southeast Asia, having a market cap between $15 to $17 billion. But again, in terms of valuation, it's still quoting at 20 times. And the 2O means there could be further upside as far as what the brokerages are saying. So looks like the dominance of IndiGo is likely to continue in years to come.
Global funds category, international funds, which are investing in, whether it's US equities or maybe you even have some greater China funds and whatnot. Now here as well, this category was first taxed at our slab rate.
Welcome back. Even as the banking results season ended with SBI, we got the global equities rout, which pushed up expectations of Fed rate hikes. And this was followed by a surprisingly hawkish monetary policy from the Reserve Bank. So at the end of it all, how are banks placed in terms of future margins, loan growth, deposit growth? For all these questions, I have with me Suresh Ganpati, the banking expert from Macquarie Securities. Suresh, welcome. Thank you very much for your time. Let me first start with what the SBI chairman Dinesh Khara told me on Monetary Policy Day about a simultaneous fall in bond yields exactly when deposit rates are shooting up. Just listen to him. I'm coming back to you.
There's a change in the interest rate structure when it comes to the lending. A lot of loans are being priced linked to the T-bill. And today, the way T-bill is behaving, in fact, the market is actually from that perspective, as far as T-bill is concerned, it's coming down. But when it comes to the liquidity issues, that actually forces banks to go for the higher cost of deposits. In such a situation, perhaps when RBI has said that they are concerned about the interest rate movement in deposit rates, I think it's quite justifiable. But I would say that there are various subsegments in the market, and they're all getting priced differently.
Okay, Suresh, the long and the short of it is the banks are facing pressure on both sides, irrespective of what the results were. Is life getting tougher? Should we be prepared for lower margins?
Yeah, I mean, that's very clear, right? So he's saying that there is pressure on deposit rates, and you have seen obviously all these banks coming up with some special deposit schemes. And funding still remains a challenge. And even the Reserve Bank of India governor said that you have to come up with some innovative schemes to get deposit growth. So clearly, there is on one hand pressure on the funding costs, and on the other hand, obviously, you have loans which are priced off T-bills, priced off external benchmark rates and stuff. So that is also showing pressure. The latest data from the Reserve Bank of India very clearly shows, specifically when it comes to the public sector banks, the weighted average deposit rates have gone up, but the weighted average lending rates have remained flat of late. So that clearly shows that there is more margin pressures to come for the sector in the coming quarters.
Okay. So will you tone down your margin expectations even after the reports you wrote after the results? Especially now, let's start with SBI because the results came the last.
Yeah.
Are you going to bring down the margin expectations and even loan growth expectations, because after all the raw material has become expensive, money?
Yeah. Look, I think, I mean, about 6 months ago itself, people obviously knew that there is pressure from the funding side, and therefore that will spill over to the lending side with respect to the ability of the banks to grow their balance sheets. So loan growth estimates have already been pared down. What I think most of the analysts, or for that matter, the market has got it wrong in our view, is the fact that we thought we have almost reached the bottom level of margins as of 4Q, but 1Q very clearly showed that margins continue to remain under pressure, and nobody expected, Lata, the LCR guidelines to come and take shape in the current format. Obviously, we know it's a draft guideline, but clearly the Reserve Bank of India is wanting to implement with effect from 1st April 2025. So before that, clearly banks will have to beef up their liquidity coverage ratios or realign, right? So either it means focus more on retail deposits or invest more in government securities, and that is the additional downside pressure to margins. So yes, across the board, for both PSUs and private sector, we do believe there will be more margin cuts coming forward in our view.
Okay. Your view on SBI itself?
We do have a self-recommendation on SBI. I think, Lata, what we are arguing here is that the ROAs have clearly peaked. There is downside pressure to the ROA coming from lower margins. And also, obviously, we will discuss this a bit later on the ECL norms perspective, whereby there will be some upward bias in terms of provisions. And we've also seen off late in the results, which we will discuss later, some signs of stress emerging across the board, right? So, so clearly credit cost normalization is only going to gather a little bit more amount of steam in the coming quarters.
Okay. Before I come to this, credit cost and the fact that unsecured loans have shown stress,
yes.
You wrote a note to that effect. Before that, let me first finish off HDFC Bank. They also stunned the market with a fairly high-yielding deposit announcement. I think 1 to 3 years, they give you now 7.35, which... Correct. If HDFC Bank gives you that kind of money, others will have to, at least match. So what is the expectation from HDFC Bank itself? Are you toning down their margins? What's the opinion on that bank?
Yeah. So look, I think they are in a peculiar state in a way, or, what has happened actually, of course, if you look at it, Lata, if you look at the ALM pattern, they do have large amount of borrowings maturing by the end of this year. And if I were to really compare the borrowings in the 1 to 3 year bucket and the deposits in the 1 to 3 year bucket, I think if they are able to garner deposits even at a slightly higher rate at about 7.4%, as we talked about, and the borrowings are coming in at 8%, or rather there are existing borrowings at 8%, it makes every sense to take those kind of deposits and replace the borrowings. And what exactly happens is they have an idiosyncratic issue which results in them actually having an ability to bring down their cost of funds because their cost of funds is affected because of the merger. That's not the case with others. So in that process, everybody else gets affected a little bit more negatively compared to HDFC Bank. And therefore, if you look at this quarter itself, well, everybody else faced margin pressures. Their margin did go up by 3 basis points. I know it's a small number, but at least directionally it was good, right? So that clearly goes to show, Lata, that they are in a different situation, and therefore I think they should be in a position to maintain or in fact improve margins from current levels and report that 14-15% earnings growth that we are talking about.
Okay. Okay, now let me come to that unsecured loans note that you wrote. Who are the biggest casualties and who are the winners?
Yeah, look, I think, Lata, let's understand that there is no casualty as such, because we have to understand that these portfolios are very granular. The risk is also concentrated in specific segments in the unsecured space. It's not across the board, all ticket sizes. Certain pockets, certain geographies, and of course, certain stress on the credit cards portfolio. So what exactly happens here is that while there is going to be an uptick in the credit cost, it's going to be well within the manageable levels. The only problem here is what is getting priced in, right? So the first instance of some normalization levels of credit cost results in the markets getting a bit more jittery. I would still presume, even for that matter, PSUs which have seen an increase in the personal loan delinquencies. Remember, for SBI, it is a very small, low-digit percentage of the overall portfolio. Same is the case with Bank of Baroda. So it doesn't move the needle in a very big way. But yes, the fact that you are running at 30-40 basis points of credit cost, even if you end up having 10-15 basis points additional credit cost, to that extent, it is negative on the ROA, earnings expectations, and of course, eventually ROE.
Okay. Well, banking stocks or the banking sector has been the underperformer of the market. So the market probably got it right. They could see that banks are going to be in for margin pressure, for probably asset quality pressure, even if it is marginal, and of course, technology investment pressure. Given this, what would your ranking be of banks? Who will be able to stem the tide?
So to a great extent, if you look at the numbers here itself, the private sector banks are still generating, despite this kind of an outlook, anywhere between 15 to 16, 17% kind of an ROE. Let's take that range, right? So, and the valuations are still very comfortable at this point in time. So even if you assume there is no further aspect of re-rating from current levels, 15 to 17% ROE can itself result in that much amount of power of compounding over the course of next I would say 2-3 years. So I would still stick with private sector banks. Also, the narrative is coming from the fact that Lata, they are gaining market share on deposits. If you look at the deposit growth of both SBI and Bank of Baroda, it's been pretty weak in single digits. So clearly they're losing market share on that. There is a greater impact coming from ECL norms for the PSUs compared to the privates. The privates carry contingent buffers and provisions. So those are some of the advantages that the private sector bank has over PSU. So you're still sticking with the larger private sector banks at this point in time.
Okay. Well, let me quickly get the fintechs in and then come back to the banks if I have time. There are two fintechs you cover, 197 or Paytm and PB Fintech. Where are they in this whole picture? Are they better able to stem the tide of margins? Are they showing better business growth?
So definitely PB Fintech has been doing a better job in our view. Growth has been, of course, surprising us positively continuously. In fact, over the course of last several quarters, they are gaining a greater market share in the segments that they're operating. One area where there has been a clear progress that has been seen is on the health insurance front, where very clearly growth levels continue to remain very strong. And they have a very small market share in the savings product segment. So coming off from a low base, they're doing pretty well. And interestingly, they've also been in a position to manage expenses and show operating leverage in their business. So in that sense, PB Fintech is, in our view, in a much better position. I still believe when it comes to 197, there are still a lot of pulls and pressures. When it comes to the loan dispersal that they do, I still believe there's quite some time away before we actually start seeing reasonable amount of growth in that segment. And secondly, I'm still not very convinced on the regulatory and aspect, right? I mean, time and again, they have, of course, had these run-ins with the regulator, and therefore we need to get a little bit more amount of comfort before we actually begin to get constructive on that name.
Time completely, Suresh. One word on your best pick.
Oh, in the current environment, I'll still stick with the two largest private sector banks, which is HDFC Bank and ICICI Bank.
Okay. All right. Unfortunately, out of time. Thank you very much, Suresh, for rounding up both the macro pressures of Fed and RBI, as well as the regulatory rules and the earnings in a very short chat. That's the word from the banking analyst. We have to take a break and come back with Chartbusters.
At 12.5% if the holding period is 2 years or longer. So Mohit, this sounds great. But, correct me if I'm wrong, a lot of funds were not taking any fresh money because of certain limits being hit already.
Yeah.
So is it even possible to invest right now?
It is. Quite a number of funds are accepting fresh investments. Few are accepting only as SIPs and few are open for both lump sum purchases and SIPs. It depends on the contours of the fund. Funds which are purely ETF based, those are the ones where the limit has got busted and those are the ones which have stopped. But funds which are actively managing their allocations, perhaps directly investing into stocks or international stocks directly, those are the ones which are typically open. There is a whole list of funds, but I think category as a whole, Surbhi, has got a huge impetus. And needless to say, for an Indian investor, it's absolutely must to have a global diversification. Given the profile of our currency, which has been depreciating against the US dollar for almost last 20 years, if you see the track record, the depreciation has been on an annualized rate around 3 to 3.5%. If you want to counter that, if you want to have a real hedge against the country risk or the sovereign risk, or you just want to create a corpus offshore for your children's education or for anything, let's say, I think this is a great avenue available to retail investors, that you go out and invest in international funds. Again, this category got completely out of flavor last year when the taxation was changed, and now it's come back into reckoning with full power and full force, and I think all investors should definitely look at diversifying abroad.
Your favorite funds here?
Look, many. Honestly, I like the Edelweiss US Technology Fund. I like the DSP Global Innovation Fund. These are all active ones, but on the passive side, I like the NASDAQ fund of funds, which currently the open one is only Motilal. I think they're accepting SIPs out there. So if someone wants to buy NASDAQ directly, I think that's a good avenue to go for.
Sun TV, the stock under pressure, down almost 9% as the company reported an operational miss in the first quarter. The revenue fell 5%, while subscription revenue too dipped about 2%, despite price hikes on account of NTO 3.0.
Voltas climbs more than 7% after delivering a strong showing in the Q1 numbers that were above estimates. The revenues from operations are 47% on a year-on-year basis, strong growth from the UCPS segment and sharp recovery in the EMPS segment.
The muted management commentary takes Balkrishna Industries lower despite posting an inline set of numbers. They expect minor sales volume growth in FY25 and see tepid demand environment due to macro challenges. That too takes the stock down by about 6%.
Jubilant Food surges as the company delivers a solid set of numbers in the first quarter. The revenues increased by 10% on a year-on-year basis. Like-for-like growth stands at around 3%.
Bunch of other stocks on our radar. We have SCI, Stovecraft and Inox Wind, all of them doing well on the back of their quarterly results. Management of Stovecraft tells CNBC TV18 they will continue to improve gross margins, while Inox Wind's management expects a significant upside to their FY26 guidance.
Hello and welcome to Chartbusters. I'm Nigel D'Souza. Joining me as always is Mangalam Malu. And as the top of the screen is telling you, well, all the indices are trading in the red, but the one you should keep an eye out on is the Nifty Bank. That's on the verge of moving into the green. That dip is getting bought into. And the big boy, HDFC Bank. As said earlier this morning, that could be the stock to focus on. That one's seen a big, uptake from the low point of the day. And it's the largest constituent on the Nifty as well as on the Nifty Bank. Could explain why the Nifty Bank is on the verge of moving to the green. Hey, Mangalam.
Let's see where that goes, Nigel. You know, any softness in terms of the market is being bought into, and any recovery from the lows is looked at as an opportunity for the resilience of our markets itself, and the Nifty Bank has recovered from the lows. But let's talk about Honasa Consumer. The company reported a good set of numbers for the first quarter, 19% revenue growth led by 25% volume growth as well. Margins too improved by 200 basis points. Ramanpreet Sohi, who is the CFO of the company, now joins in to discuss the quarter gone by, but more importantly, what the near-term concerns are as well. Raman, thank you so much for joining in. The first quarter was good, no two ways about it. 19% revenue growth led by 25% volume growth as well. But, you know, one of the comments in your PowerPoint presentation when it came to the revamp of distribution has the street a little worried. In terms of inventory offsets that you are likely to do for the distribution revamp, what could the potential impact in the near term be as a proportion of your sales?
Yeah, hi, good morning. Thank you for having me. Yes, of course, like you said, of course, we had a good first quarter numbers in, and as part of our annual sort of charter, we've actually set on a project called Project Neve, where we are actually transitioning our distribution from a super stockist-led distributor model to a direct distributor model. And in the process, we've obviously completed some part of transition, but majority of the transition is going to happen in over this quarter and the next quarter. And hence, as we sort of transition and take out a layer of distribution, which is super stockist, we are accelerating the transition, and hence there is a likely impact of about 150 to 200 bips from an annual delivery perspective.
So 150 to 200 bips is the inventory correction that one is likely to see. What does that do to your annual guidance of 20% revenue growth with 150 basis points margin improvement? Do you hold on to that? And is there an upside risk to, this inventory correction that you're doing in the market?
See, so, let me clarify that aspect. We are very clear that we are accelerating this transition, and we will do this all in a single quarter. And hence, the quarter that we do this in, we will see a one-off exception from a delivery of a top-line perspective and some impact on the bottom line as well. Having said that, for the rest of the quarters in the year, we are likely to go back to our guided strong growth that we've been delivering all through last year and in the first quarter, and also continue our margin uptrend in terms of the scale efficiencies and deliveries that we've been seeing. So, barring one quarter where we're trying to accelerate and be ready for and unlock a long-term sustainable, general trade transition potential for us, we will go back to our normal sort of strong growth on the top line, and as well improving bottom line margins as well.
All right. Hi, Ramanpreet. Good morning, and thanks a lot for speaking to us here on CNBC TV18. This is Nigel on this side. Since you briefly spoke on margins, and margins have improved over the last few quarters, what is the guidance from here on? I recall, it being just 1-2%. It improved to around 7% in the past year. And now you're at, northward of 8%. So for the year, what's the number we should work with? And the key variable when we talk about margins is the ad spends, which are in the mid 30% mark. So for the year, guidance on both these two?
Yeah, absolutely. So, as you've seen in first quarter, we've actually delivered almost 200 bips margin expansion on a year-on-year basis. And, if I sort of exclude the one-time correction driven by our distribution transition, we will move back to our guidance of 150 bips margin expansion on a year-on-year basis. And this will sort of continue not only this year, but next year as well. We feel very confident in terms of how we've seen margin unfold even in Q1, given our growths, and we will continue to work towards improving margin trajectory. And there is fair bit of confidence on 150 bips margin expansion coming in. Of course, like we've sort of said in the past, as the business scales, all our brands as they scale are becoming more efficient, and a part of our margin expansion will come from A&P efficiencies that we see as our brands scale.
So what would A&P settle at? Because I remember FY24, they settled around the 34.5%. The first quarter, you've done around 36%. Competitive intensity is high as well from all quarters. So at what level do A&P spends settle?
See, very difficult to pinpoint exactly at what level, but if you actually look at our guidance of 150 pips expansion on a year-on-year basis, 30 to 40% of that should come through A&P efficiencies.
All right, so 60-70 basis points comes in from A&P efficiencies. I wanted your thoughts on two things. One, offline as a proportion of sales. Now you've reached 2 lakh stores. You are revamping distribution. Last time you joined us, you said about a third of your sales come in from offline. So going forward, what rate is offline channel likely to grow at in the overall growth of 20% that you've guided for? And new products as well. In the first quarter, it's 9%. All of last year, it was close to around 18%. So how much do new products contribute to your revenue going forward? And offline sales as a proportion of your overall revenue comes to what?
See, just to put some perspective to it, currently, of course, Mamaearth, which is the largest brand, offline channel is driven by Mamaearth, specifically our younger brands. Our second brand, which reached a 500 crore annual run rate in the previous quarter, in Q4 of last year, continues to do well, and we now slowly moving that brand also in key offline accounts as well. It started with modern trade and then some key beauty counters as well. It's going to be a gradual progression as we move younger brands into offline. But typically, Mamaearth is going to lead the offline charge for us, at least in the near term to medium term. Having said that, given all our younger brands are online first brands, digital first brands, the mix of offline online is likely to be in the same ratio for the near term and the medium term. And of course, as the younger brands move offline, we'll then see offline contribution to the overall business also move up over time.
Okay, all right, Ramanpreet, final question before we let you go. You've given us targets for Dermaco, 500 crores for Aqualogica, as well as Dr. Seth's, and 250 crores for B Blunt. By when do you hit all these targets?
We continue to be very positive on how these brands are being loved by our consumers. In fact, B Blunt actually reached 100 crore in annual run rate, which we've scaled almost 4x since we've acquired within 2 years. So we're very confident on how these brands are being loved by consumers, how they are doing on our online platforms. And as we take them offline subsequently, we'll see that some of these numbers that we guided over the next 2 to 3 years, we should be able to hit these run rates.
Quickly, if you could tell us, where are they right now? B Blunt, you said, is at 100 crores. Where is Dermaco, where's the Dermaco, where is Aqualogica? Where do those brands stand right now in terms of ARR?
See, we normally announce the brand milestones as they hit new milestones. Having said that, we continue to see them scale up. The last announced milestones for each of these brands were 500 crores for the Dermaco. B Blunt, we just announced this quarter 100 crore annual run rate, and Dr. Shade and Aqualogica are between 180 to 200 crore run rates.
All right, we look forward to them hitting the milestones that you spoke about, but more importantly, breaking even as well and contributing to the EBITDA as you're guiding for 150 basis points improvement. So the next couple of quarters may be blip because of that inventory correction to the tune of about 100-150 basis points, but thereafter 20% sales with 150 basis points margins is what you have guided for. We'll hold you on to those numbers. Thank you, Ramanpreet, for joining in and giving us those details. With that, let's shift focus to a special segment. We get you ideas for profit coming in from our colleagues at Money Control Pro. And today we have Jitendra Gupta joining in with the stock.
Given the volatility and uncertainty in the stock market, Bharat Electronics should do well. We have been bullish from the levels of around rupees 92 in September last year. Even at current levels of around 300 rupees a share, it offers good value. The company has a healthy order backlog of close to 76,000 crore, providing strong revenue visibility for the next 3 years. During fiscal 24, the company backed orders worth rupees 35,000 crore as against its earlier guidance of 20,000 crore. In current fiscal as well, the company is expecting order inflows of close to 25,000 crore, which doesn't include LRSM orders. It is a conservative estimate that the company has provided. Notable point is that the execution is quite good in Q1. It delivered 20% growth in the revenues, and of course, because of led by strong order book and focus on exports. In terms of EBITDA margins, it has guided to achieve 23 to 25% margins, led by better revenue mix. On valuation front, I would say stock is trading at 35 times, which is quite good. More in the light of earnings visibility supported by strong order book and improving execution.
All right, Jitendra, thanks a lot for that. Take a short break, come back. On the other side, we have the management of Kirloskar Ferrous. R.V. Gumaste joins in to discuss the quarter gone by.
Well, let's turn our attention to Kirloskar Ferrous. The numbers actually in the past quarter were disappointing. Remember, this is a stock in the last 3 years that's moved from around 100 rupees all the way to around 700 rupees. To understand what's the way ahead from here on, we have Mr. R.V. Gumaste, who's the managing director of the company. Hi, Mr. Gumaste. Good morning, and thanks a lot for joining in. Well, let's focus first on the volumes. It's been a soft start to the year. How do you see the volume picture pan out from here on? If you could first start by telling us about casting, where there was a small growth of only around 1%, and pig iron business. What do you end this year with on both these two segments? And then for ISMT as well, the acquired entity, how do you see the tubes and the steel sales numbers go on? Please go ahead, sir.
Yeah, on the casting front first, the quarter one was very soft. Demand from tractor sector was still not really up to the mark. And also first quarter typically has been a soft quarter. And from 15th May or the end of May onwards, the things have improved. Demand for castings from tractor as well as the auto sector has picked up, and definitely I look forward to much better numbers for quarter two onwards, and we should this year achieve decent growth compared to the last year figures. And
so
moving, yeah.
What is the number, sir, for castings? What is the number? I think earlier we were talking about something in the vicinity of 1.4, 1.5 lakh, I think is what we had discussed last time. What should that number look like for casting and pig iron?
No, I think for the casting, if you look at, we have 2 foundries in Solapur, and we are ramping up the production and sales. And second half of this year, we will have Oliver Engineering, our Punjab foundry, joining the production and sales. And we look for really more decent numbers, much better numbers towards our installed capacity now is more than 2 lakh metric ton per annum. So from that angle, I would look for a good progress in the sales volumes from casting.
Give us a number, sir. You want to give it to us? The casting business, the casting business of the core business and Oliver separately as well, or you want to give it to us? If you could break it up for us. Let's get casting out of the way first.
Yeah, first casting out of the way. Our current run rate is 13,000 metric ton per month. That's what we are doing right now. And with Oliver Foundry joining, I should add at least 1,000 tons more, and Solapur should add another 1,000 tons into Q3 at least. So these are the numbers we are looking at, I think, which will result into substantial growth for this year compared to last year.
So second half of the year will be 15,000 per month, 13 plus 1 plus 1, correct?
Yes, please.
So you're bracing for roughly 150 to 160,000 tons this year in terms of volumes?
See, the first thing is to cross the 40,000 per quarter. I think we are keen to look at the earliest, and subsequently we should go another 3,000 per quarter extra. We are looking at crossing more than 150,000 this year.
All right, 150,000 this year. What about margins? If you could give us a sense of blended margins in the very near term, and thereafter recovery in the second half as utilizations go up, newer capacities come in. So what kind of blended margins can you give us?
No, I think we would definitely maintain the EBITDA levels of 15% and above in casting, especially the only the pig iron has been. The entire iron and steel industry is under pressure of margins, and we continue to do that. And we are commissioning oxygen enrichment by the end of October. That should help us in increasing the pulverized coal injection, which should help us to mitigate the cost to some extent. And we are also looking for our iron ore mines to become operational, which has been the point in pending for very long, and hopefully, the light at the end of the tunnel. I expect second half that should add value to us, and thereby I think the blended margins, both the pig iron and casting, should improve in the second half of this year.
By how much?
See, it is quite dynamic. I refrain from giving numbers because they could go absolutely wrong because of the movement both on the product pricing. Commodity and pig iron has been very, very, unpredictable.
Okay. But, the blended margin that we are working with for as the end of first quarter is around 11%. So you're saying Q2 will be a little softer because pig iron prices as well will be under pressure, and then we'll see the recovery in the second half of the year. Is that correct, sir?
No, I think I expect improvement in the overall margin even for Q2, and Q3 and 4 should be better than Q2.
Got it. All right. So for the year, sir, should we work with an average margin of around 13-14% at least?
No, I think our effort would be to recover our 15% margin.
Got it. Oh, that will be good news then. Superb. Also, you briefly mentioned this iron ore mines. Are they operational now? The last time around when we chatted, you said you're expecting at least 2.5 lakh tons from that iron mine, which could help you all save roughly around 40-50 crores. Is that on course?
Around. The volume, first year volume would be 2.2 lakh metric ton mining and to be moved to our factories. And next year, I can expect it to go to 2.4 lakh metric ton with only one mine, which is likely to become operational shortly.
Okay. All right. Very quickly, sir, you've been talking about some capacity addition, some focus on cost saving as well. Last year, capital expenditure was around 520 crores. For this year, what is your total capital expenditure? And currently, what is the debt in its books? Where does it go to?
I think the capital expenditure even in this year would be in the range of 500 to 600 crores. Okay. And the debt levels will remain same in the range of about 800 to 1,000 crores. No major shift. I think most of the projects are getting funded with the cash we generate.
Pleasure talking to you, Mr. Gumaste. Thanks a lot for joining in here on CNBC TV18. The endeavors to move back to around 15%. You're optimistic that things improve and the debt number will hold at around that 800 to around 1,000 crores odd. Thanks a lot for joining. For the time being, the stock is under pressure. But as I mentioned, in the last few years, it's up nearly around 5 times odd. For the time being, slip in a short break, come back. We'll continue to focus on the markets that have seen a big recovery from the low point of the day. Well, on expected lines, the resilience of the Indian markets again has come into play. Take a look at the big recovery we have seen in the Indian markets, and you pull up some of these Adani Group stocks. Let's get a few of them up for you on the screen. Both the stocks that are part of the Nifty, that's Adani Enterprises as well as Adani Ports, both of them a big recovery is what we are seeing from the low point of the day. The next couple of them should come up for you as well on the screen. Adani Green has seen a good recovery. You have Adani Energy as well. You know, those dips on both these two have got bought into. So both of them now moving towards the high point of the day. And the cement twins as well. Ambuja Cements, by the way, has moved into the green. I recall it was down close to around 3.5%. So big recovery is what you're seeing. So in short, the Adani Group stocks have seen a recovery. HDFC Bank is leading the Nifty Bank higher. And as we speak, Mangalam, from the red that we saw at the start of the show, most of the indices are in the green. But that's it from Mangalam and myself and the entire team that put the show of Chartbusters together. Stay with us. Trading Hour comes up next.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go.
Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC TV18, now streaming live 24/7 on YouTube.
Good morning. Welcome to Trading Hour. I'm Reema Tendulkar. With me is Sonia Shenoy, and markets are recovering. We're back in the green. In the morning, there was a knee-jerk reaction. At the session lows, the Nifty was down 150 points, and now we're up close to about 30-odd points. And even the Adani Group stocks pulled them up. Again, in the morning, there was a gap down opening. Stocks were down close to about 4 or 5% for many of them. And now they're cutting their losses. And the big recovery seen in the banking names. So the Nifty Banking Index is up 200 points with names like Kotak Mahindra Bank, HDFC Bank fighting for the bulls. For HDFC Bank in particular, there is also that MSCI Rejig announcement, which is expected at 3:30 p.m. tomorrow. So there is an expectation that HDFC Bank's weightage will go up. So there are likely to be inflows. So some pre-buying is seen in names like HDFC Bank. And according to Nuvama, some of the other potential candidates for an inclusion are Vodafone Idea, RVNL, and these are some stocks where there is buying today.
Oh, absolutely. And what a morning, right? After all that happened over the weekend with the Hindenburg report, with all of the talk back and forth, the market has recovered, and how? I mean, the Nifty has actually recovered about 200 points from the lows that we saw. It's back above the 24,000, almost at 24,400 now. So it's really interesting to see how this market just climbs every wall of worry. It has a single point razor focus, so to speak, which is to sort of get over every hurdle. And the buy on dips is something that this market is seeing. By the way, I just want to make a special mention to Ola Electric as well. It's day 2 of Ola Electric, and it is once again on upper circuit. So clearly the market keeping the faith with this one, looking at a lot of the recovery that we've seen in this stock. So, or rather recovery in, the kind of sentiment, right? I mean, it's gone through so much, this company. First, the valuations were scaled down, and then you had, other issues as well with respect to losses, etc. But since listing, it's just been up and away.
Indeed, and it's taken a lot of people by surprise too. Like, no one anticipated that day 1, listing day, and day 2 is going to be so strong for the markets. But it's a big day in terms of individual stock reactions. So there is Voltas on the way up, reacting to their numbers. On the way down, there's Sun TV, disappointing numbers. And let's also talk about Balkrishna Industries. How were the numbers, Sonia?
So the earnings were largely in line with estimates. Okay. There were no problems with the earnings, but the commentary is what is muted, and that's something that has resulted in the stock being under pressure right now. If you look at it, the margins have actually improved to about 24.4% versus 23.2%, and the estimate was about 24.6%. So largely in line numbers, slightly improvement in margins, etc. But the volume growth is in line with estimates as well. It was not a bad volume growth. 24% volume growth is what the company has seen. But I think it's the cautious commentary that has caused the stock to be a bit subdued this morning. So if you look at what the management is saying, right, they're talking about softening of demand. They're talking about very minor sales volume growth in FY25, so hardly any growth. The demand is tepid. There are macro challenges. The channel inventory is increasing, and they will strive for maintaining EBITDA margins of last year. So I think it's this cautious commentary that the street doesn't like. Let me quickly take you through what brokerages have made of the numbers. Morgan Stanley has an underweight. They have a target price of 2,133. Investec has a sell with a target of 2,360, and Nomura has a neutral with a target of 3,115. And this stock generally has a propensity to disappoint, either in terms of the numbers or the commentary. And whenever there is a disappointment, the stock reaction is quite adverse, and that's pretty much what we're seeing this morning. But on the flip side, Jubilant FoodWorks has hit a new high. Honasa Consumer is also in focus on the back of Q1 numbers. Mangalam is here with the details. Mangalam, over to you.
Well, good numbers coming in from Jubilant FoodWorks, especially given the sort of environment that we're currently in. The company has reported, 3% like-for-like growth, and the street was working with a number of 2 to 3% as well. At the higher end of expectations is what the company has reported. But, you should not look at just that 3%. Beneath the surface, there's a fair amount of strength. The delivery like-for-like growth has come in at around 12.1%, and that accounts for nearly 70% of their sales. Add to that, if you look at all the other QSR players this time around, barring Burger King, which did a like-for-like growth of close to around 3%. Westlife reported a decline of about 7%. Whichever way you look at either Devyani or Sapphire, Pizza Hut and KFC saw a decline of around 7 to 9% as well. So in that, the outperformance of Domino's really stands out. The reported numbers as well, the revenues closer to 1440 crores, above street expectations. The EBITDA at around 280 crores, in line with expectations. Even the net profit a little over 51 odd crores as well. The key internals were strong as well, with them having added nearly 34 Domino's stores during this quarter. At the same time, they've added around 8 Popeye stores, so the Popeye franchise has now moved to around 50 odd stores itself. And the acquisition of DP Eurasia panning out well too, with Domino's Turkey showing double-digit like-for-like, and the beverage brand Coffee has also seen a near 7 to 8% sort of like-for-like growth. So with all of this, the street believes that going forward, maybe, the worst is behind Jubilant FoodWorks, and as a result of which, we've seen a couple of brokerage upgrades come by this morning as well, the most notable one from Jefferies.
Thank you very much for that. Let's Okay, before that, let's also talk about Honasa Consumer. How did the numbers look? Because the stock is under pressure.
Well, the numbers look good, no two ways about that. But, you know, the stock is under pressure on account of the near-term uncertainty that the company has spoken about. So if you just take a look at the results, you know, 19.3% revenue growth led by nearly 25% volume growth is something that is much higher than the industry, and it's pretty strong as well. And that's led to a 58% jump in the EBITDA margin improvement of almost 200 basis points and a near 60% jump in the net profit as well. What really the street does not like is, one, there could be near-term uncertainty with regards to their distribution revamp that may impact sales by about 100 to 150 basis points over the next couple of quarters. And secondly, the ad spends. Year on year, the ad spends have actually come in at 36% of sales versus 35%. The company believes that, you know, further downside to this could be limited just to about 70-80 basis points, as they are guiding for 20% revenue growth in normalized quarters with 150 basis points margin improvement. So in the very near term, this inventory-related uncertainty has the stock sulking in today's trading session, but the numbers are pretty strong. We've seen good market share gains across Mamaearth as well as new products doing about 9% of their overall sales.
Okay, thanks a lot for that. So Honasa down almost about 4% strong earnings, but management commentary muted. Voltas is the other one which is doing exceptionally well this morning, 6% higher on the back of a very strong set of Q1 numbers. Upasana is joining in with more details on that. Upasana, over to you.
Thanks so much for that. Voltas reported strong set of numbers in its Q1 FY25 above street estimates. Strong growth was mainly driven by the company's UCP segment, which is nearly 77% of the sales. EMPS segment also recovered sharply this quarter and turned positive. Now coming to revenues first, the revenue stood at 4,921 crores with an uptick of 47% on a YoY basis. EBITDA saw growth of nearly 1.3 times at 424 crore, leading to a sharp EBITDA margin expansion of 310 basis points at 8.6%. PAT stood at 335 crores with an uptick of nearly about 1.6 times. Now coming to company's key segment, first up is UCP segment, which was the key growth driver. As stated earlier, recorded a strong revenue growth of 51% on a YoY basis, and margins in this segment also expanded by 40 basis points at 8.6%. Company's EMPS segment turned positive and revenue growth was about 40% on a YoY basis and margins turned positive at 7%. And lastly, company's engineering products and services segment saw a revenue growth of about 13%, but margins declined by 100 basis points at 28% on a YoY basis. So all in all, strong set of numbers reported by Voltas in its Q1 FY25.
Okay, thanks a lot, Upasana, for that. Appreciated. Let's slip into a short commercial break. On the other side, we'll put the spotlight on the big story, Hindenburg research allegations against the SEBI chairperson. More on that coming up.
Patient distinguish between a migraine or any other type of headache, and there are many types of headaches such as tension headaches or cluster headaches or brought on by other conditions as well.
Yes, the common headaches with which migraine can get confused are what is known as tension headaches, the sinusitis-related headaches, and much rarer are what you mentioned, cluster headache and new daily persistent headaches. Now, migraine is easy to recognize if you know the features, because as you have already mentioned, these are recurrent headaches which are associated with sometimes nausea, vomiting, inability to tolerate light, sound, sometimes smells, and they are highly disabling. The patient may not be able to function for almost 24 hours or even more. And there is a positive family history of not the same severity, but some recurrent headaches. Now, as against this, when you look at the other headaches, tension headache, they are more or less what we talk about them as featureless headaches. They are not associated with nausea, vomiting, disability, and they don't have trigger links so clear-cut as in migraine. Okay. And then when you come to cluster headaches, they are more always on the same side, accompanied by watering of the eyes, running nose.
Welcome back to Trading Hour on CNBC TV18. Well, Hindenburg Research has put allegations on SEBI chairperson on counts of conflict of interest with regards to the Adani Group and questioned her credibility in investigating Hindenburg's allegations against the Adani Group. Nisha has been tracking the story from the word go. She gets us the full account. Nisha, over to you.
Yes, thanks for that. Hindenburg Research's recent report puts allegations on SEBI chief Madhabi Puri Buch by highlighting her conflict of interest with Adani Group and therefore raising some serious questions on her credibility. While SEBI chairperson has refuted claims by pointing to disclosure and recusal norms she has diligently followed. Now, Hindenburg alleges Madhabi and her husband Dhaval had investments in two funds which they claim have been used by Adani Group for siphoning off funds. Now, they highlight the involvement of 361 in managing these funds, and report suggests that the first investment in 2015 while Madhabi joined SEBI in 2017. Now, by establishing these linkages, Hindenburg claims that SEBI has been reluctant to probe Adani because of chairperson's involvement. Now, SEBI chief, in her strong rebuttal, has denied these claims and explained that investments in fund was in 2015 as private citizens and states emphatically that at no point did the fund invest in Adani Group's companies. Now, in another point of conflict of interest, the report claims that Buch had interest in offshore Singapore consulting firm Agora Partners and continued with her ownership of Agora Partners despite being SEBI's whole-time member. Now, Madhabi said that all disclosures and recusal norms of SEBI were followed, refuting the charges of the conflict. Not just Singapore entity, but even the Indian entity Agora Advisory India, and Hindenburg claims that Buch has 99% stake in the Indian consulting firm, which, remember, is generating nearly 2 crores from advisory services in FY22, is what the report claims. Now, SEBI chief clarified by saying that the two consulting companies became immediately dormant on her appointment with SEBI and that her shareholding in them were explicitly part of her disclosures to SEBI. Now, apart from linkages to Adani Group, the report also claims that Madhabi had conflict of interest with global private equity firm Blackstone, and Hindenburg's report says that Madhabi Buch used her position to benefit Blackstone in REITs in India and that her husband Dhaval Buch is acting as an advisor to Blackstone despite no experience in funds or capital markets. Here again, SEBI chief clearly refutes claims by disclosing that Blackstone Group was immediately added to Madhabi's recusal list maintained with SEBI when Dhaval was appointed in this position. Now, in two statements yesterday, Madhabi Puri Buch has emphasized repeatedly that all disclosures and recusal norms of SEBI were diligently followed by her, and SEBI chief stated that instead of replying to show cause notice, Hindenburg has decided to attempt a character assassination of SEBI chairperson.
Okay, thank you. Very well explained. Yash is also joining in with the details on the others in the Hindenburg's crosshairs. Yash.
Hindenburg report just does not put the highest chair at SEBI in suspicions, but it also questions the institution and its conduct. It also questions Adani and its role, Blackstone, which is one of the largest player in the REIT space, along with brokerage firm 361, formerly known as IIFL Securities. Let's start with the allegations against SEBI itself. Hindenburg, in its report, has said that SEBI chairperson Madhabi Puri Buch and her husband Dhaval Buch had invested in offshore funds which were allegedly used by Adani to siphon off money. It was this investment which came in the way of SEBI's investigation against Adani and also the offshore funds in question. It is because of this why Hindenburg has also stated that SEBI can't be trusted as an objective arbitrator in the Adani matter. SEBI was also quick to respond on these particular allegations. The securities regulator has said that allegations made by Hindenburg have been duly investigated. Also, the chairperson had recused herself from these investigations for any potential conflict of interest. SEBI has also cautioned investors on the conduct of Hindenburg, stating that its disclaimer that it may have short positions in the entities mentioned in the report. Speaking about Hindenburg's allegation against the Adani Group, it says Adani used global offshore funds to siphon off money and reinvest them in the Indian market. SEBI chairperson's alleged involvement in the same funds came in the way of its investigation against Adani. Adani has called these reports malicious, mischievous and manipulative and being done with the intention of profiteering. An important clarification which Adani also gave was that it has no relation with any individuals mentioned in the Hindenburg report. Hindenburg has also questioned the offshore funds which were opened through 361 or IIFL. It says that these funds helped Adani siphon off money and reinvest them in Indian markets and also Adani Group stocks. The report has said that Madhabi Buch and husband invested in these funds opened by 361. 361 has said that these funds made zero investments in Adani. Madhabi Buch and Dhaval Buch's holding in the fund were less than 1.5% of the total inflow into the funds, also saying that the funds are fully compliant with all applicable regulations. Another party against which Hindenburg has made serious allegations is Blackstone and Dhaval Buch's role there as an advisor. The report says that Dhaval Buch's employment and Blackstone benefited from SEBI's regulations on REIT investments. Dhaval Buch, in his response, has said that his appointment at Blackstone predates Madhabi Buch's appointment as SEBI chairperson. Also, he says that at no point of time was there any association of him and the real estate side of Blackstone. Hindenburg sent a late-night counter asking if SEBI chairperson would commit to a full, transparent and public investigation into these issues. AMFI, which is also known as Associations of Mutual Funds, has said that they on the recent criticism against SEBI chairperson, stand by her and it's an attempt to undermine India's market progress, and added that India's financial system is fostering growth and innovation with high integrity.
Oh. All right, Yash, thanks a lot for that. In fact, let's listen in to what the DEA secretary had to say on the allegations against the SEBI chief.
SEBI has made has given a statement. Chairperson has also made a statement. I have nothing further to add on that. As I said, that both of them have made the concerned person as well as the organization, regulator has made the statements, and there is nothing further to be added by the government.
Okay, that's the big story for the day. For now, we get into a short break. On the other side, we'll invite the management of Neogen Chemicals to talk about their Q1 numbers and the way forward.
They don't have trigger links too. So it is not difficult, and the commonest mistake which patients make on their own is to think that all recurrent headaches are due to a refractive error in the eye, and they go for an eye check to the ophthalmologist. They may have a small number, but they have to remember that if there are trigger-linked headaches, that eye problem is not the cause of their headache, and they have to seek correct medical opinion.
Okay.
Well, we're turning the spotlight on Sanjiv Goenka companies. Remember, he did an interview with Shireen Ban here on CNBC TV18, and from there, well, the stock market has got a little bit excited, at least on a couple of the companies that he is heading. Let's run you through a few details. First, the entire piece comes up. You have the power and utility company, you have the KPO that he runs out there, the largest carbon black company here in India. You have the music library as well, the retail venture, as well as the holding company. So that's basically the entire bouquet of companies that Mr. Goenka does head. The street actually got excited with that one statement that he says he believes the entire market capitalization of the group will go to around 2 lakh crore odd. Currently, it's around 72,000 crores odd. So the aggression that, the street has read it as a rather aggressive statement. As of now, 71,000 crores is the total market capitalization, and bulk of it comes in from CESC, from First Source, as well as PCBL. And both these two is something that the street is quite optimistic on. Let's focus on PCBL first. The margins have improved gradually over the last few years from around 14%. It's come up to around 16%. Profitability as well has gone up big time from around the 300 crores all the way to around 500 crores. But what he said was he's expecting margins to improve even more. He's talking about 17 to 18%. And he's saying the profit number from 500 crores, it could go up nearly around 5x. Now, those are big and tall targets. If you look at the Bloomberg estimates, then on FY26 numbers, the stock is trading at around 22 times. But if in case the profitability goes up by 5 times in the next 5 years, then it's at around 7 times odd. So that's about PCBL. Moving to FirstSource, that's been actually an underperformer. It's not grown as much as the market. The street has been quite disappointed out there. But they have gotten a new CEO last year. And earlier he had roles at Tech Mahindra as well as Infosys for more than 10 years. At Tech Mahindra, he was heading their BPO division and he had reported very, very good revenue growth of close to around 20%. So now the street is optimistic that maybe in fact this growth that is looking quite subdued over the last few years, barring the COVID period, maybe FirstSource can continue to grow from here on. And one of the things that they have done is they've gone ahead and they've upped their guidance. They've upped it for the current year to around 11.5% to around 13%. The long-term margins, they are talking about going to around 14-15%. And if you look at the valuation parameter, even after the recent run-up, it trades at around 20-25 times. So that's on FirstSource's.
Welcome back. Let's talk commodities. And now Manisha is joining in and she's focusing in on copper. Manisha.
Well, thank you for that, Rima. Yes, copper prices seem to be rebounding smartly right now. Remember, we have seen the prices decline by 12% in the past month. Copper prices did fall to a 4-month lows as well. But some bit of buying seems to be now emerging, as you can see on your screens as well. This is after better than expected data that we've seen come in from China. The inflation numbers came in better than what the street was anticipating. You also have stronger US data now coming in, and the rate cut expectations now seem to be getting stronger. If you look at the Shanghai copper inventories, well, we have seen almost 23% of decline into that from the month of June. And then there are also potential strikes looming in on Escondida mines there. And that's exactly where the positive cues really end, because when you look at the markets, otherwise, the LME cash discount still stands tall at $123 per ton as compared to a 3-month contract there. So out of China, the demand still seems to be struggling, and we have seen higher inventories. The fund managers also, when you look at their net long positions, that has come down by 87% since the month of May, and the buying there hasn't resumed yet. So these are a couple of factors that the street will be watching for. But the markets do believe that after that 22% of decline from its all-time highs in sense of copper from this year, perhaps the markets are now close to bottom and some opportunity buying could be happening.
Okay, thanks a lot for that. Well, copper prices off their 4-month lows, but Soni Patnaik from GM Financial Services is joining in for a quick technical check of the market. Soni, this is such a resilient market, right? I mean, at every point, this market bounces back, and how? And today as well, I mean, it's a bounce back about 200 points from the day's lows. How are you feeling about that? What do you do for the rest of the day? And any interesting stocks that stand out for you now?
Hi, good morning, Sonia. Thank you for having me on the show. I think, yes, definitely we can see Nifty has bounced back, but the support is around 24,200, which is still quite intact. And as long as the support is not breaking, you know, we can see higher levels of maybe 24,500, 550 levels that can get tested. So there's a bout of short covering coming in Nifty only above the levels of 24,350 odd levels, which it's almost hovering and, you know, sustaining above that. So I think we can see it heading towards 24,500, 550. There could be some sort of resistance around those levels. So maybe again, you know, a bit of a profit booking from those levels. But the overall broader range remains quite intact, and there can be a gradual rise in the markets as we go on. I think similar for Bank Nifty, 50,000, 51,000, 1,000 point range of consolidation. And Bank Nifty has seen good support of 50,200, 50,400 on intraday basis. Holding those support, there's a chance that Bank Nifty can also test its resistance level of 51,000, 51,100. And any move above this resistance, you can see Bank Nifty reclaiming its 52,000, but that will definitely be a positional play. So I think it's just a bit of a wait and watch for indices. But when it comes to the stock specific, we've got two stocks which are giving a good breakout today on intraday charts. The first would be Petronet LNG, which has given a very strong breakout on intraday charts at the back of fresh long built-up positions. So one can buy Petronet at current levels of 370.71, keeping a stop loss of 360 and a target of 385 to 390 for a positional play can be seen. The second pick comes in for PFC, which is consolidating in a very good range of 480 as a good support. On the higher side, 500, 510 is a resistance. So one can accumulate PFC at current levels, keeping a stop loss of 480 and a target of 540.
Thank you very much for that. Let's talk about Sun TV under pressure, 9% lower after numbers missed street expectations. There is a Motilal Oswal downgrade too. Vamakshi joins in with the details. Vamakshi.
Well, absolutely. It's a weak set of numbers for Sun TV. When we look at the revenue, it came in at 1,276 crores. This is a downtick of 3% and a 2% miss as compared to the street expectations. Largely, this decline is being led by their advertising revenue, which saw a dip of almost 5%. Subscription revenue too was down 2% and IPL revenue saw a downtick of almost 3%. EBITDA margin came in at 55.4% for the company. This is down nearly 433 basis points as compared to the same quarter last year and is much lower as compared to street expectations of around 60.3%, and this decline is largely being led by a decline in revenue as well as higher operating expenses which were up almost 7% and other expenses. EBITDA resultantly came in nearly 10% lower. It's a 10% miss as well as compared to expectations, and net profit was down nearly 6%. Some support came through from the other income, which was up nearly 21%. A couple of brokerage notes on Sun TV. Motilal Oswal has downgraded its rating to neutral from buy. They've given a target price of 860 per share. They say that prolonged weakness was seen in the ad revenue, risk around market share loss, strong competition from deep-pocketed OTT players continued to pose concerns for the company. They've gone ahead and cut their EBITDA estimates by around 10% each for FY25 and 26. They're expecting a revenue PAT CAGR of 3% each for FY24 to 26. Overall, Motilal Oswal has downgraded its rating on this counter, but Novama, on the other hand, has retained its buy call target price of 1,075. They say that due to a weak performance in Q1, they too are trimming their FY25 and 26 EPS estimates by around 4% each. But with ad spends by FMCG players on the rise, they're expecting a revenue pickup going forward, and any value unlocking in its IPL team could be a re-rating trigger as well. So overall, Sun TV has reported a weak set of numbers. We have the Motilal Oswal downgrade coming in as well. The stock is under pressure as of now.
Okay, well, thanks a lot for that, Vamakshi. We'll slip into a quick break, more on the markets and on lots of buzzing stocks coming up on the other side. Stay with us.
The other piece that we're looking at, this is an interesting one, because the other way to play Firstsource is play the holding company. So RPSG Ventures, it has close to 50% stake in Firstsource. That's valued at roughly around 11,000 crores. The IPL franchise as well, 51% is held under this franchise. And the football club, Mohun Bagan as well, is under this one. They also have a group of FMCG companies, and 3 of them come up for you on the street. And I understand that as of now, 2yum is doing revenues of close to around 1,000 crores. So that's the holding company that they have as well. Scaling up of the retail business is going to be interesting. For the last few quarters, they haven't got past that 550 to 600 crores. Margins have been very, very minimal or absolutely zilch as well. So that's a smaller part of the business. The street believes that as of now, the market capitalization of the entire group is around 70,000 crores, but they have taken note of that target of around 2 lakh crores odd. So let's see how they get there. But those are the broad companies that he is heading. PCBL and Firstsource, I'm going to keep an eye out on both those two.
The Indian markets have not just grown, they've broken several records in the last 25 years.
India's contribution to incremental global GDP was as low as 0.2% 25 years ago.
Over the last 25 years, CNBC TV18 has closely followed the remarkable ascent of India's pharmaceutical sector.
There was a time 25 years back that it was all about the FIIs. If FIIs would buy, markets would rally. If FIIs would sell, market would fall.
Earlier, we were net importers of steel.
From IT services to SaaS, from consumer electronics to space tech, from mere programming to AI ML.
Cars, two-wheelers, three-wheelers, commercial vehicles have...
So Neogen Chemicals reported a good set of first quarter numbers. The revenues were up 9%. According to the company, the revenue growth was led by volume growth. Harin Kanani, the managing director at Neogen Chemicals, joins us now to discuss their Q1 performance and the outlook for FY25. Harin, thanks a lot for joining in. Appreciate your time here. Good numbers coming through for the company. But I just wanted to start by asking you about pricing because, you had mentioned last time around that pricing continues to be under pressure. Is there any possibility of it improving from here on? How is the situation on the ground right now? And what's the expectation for FY25?
I think on the pricing, we have basically seen that the lowest price of our raw material, lithium and bromine, we have seen. And also, from our competition in China, they've been very aggressive last 1.5 years. But most of the places we have seen the lowest prices, and then now maybe the prices are slightly remaining stable or recovering. Overall, as a market, what we have seen is we've seen a very good response and interest in our beauty chemicals related organolithium molecules. So those are doing very well. We have started some revenue contribution coming even from our battery material business. We have seen pharma almost stabilize and improve. Except for the pricing part, there's a good volume growth we are seeing there. We are seeing also volume growth in our inorganic lithium. Agro still remains a bit of a concern, and there are still other initiatives which we have taken, advanced intermediates in pharma and our CSM business in other industries, which including some semiconductor related projects, which we hope will basically allow us to make up for in case agro doesn't recover fully or we still see headwinds in the agro sector.
Okay. You said the battery material business also contributed in the current quarter. How much did it contribute? And, if you could give us, say, the exit contribution of battery materials by FY25 end.
So, the battery sales were mostly related to only trial sales for all the three segments. So some basic lithium salts, as well as advanced lithium salts, electrolyte salt, as well as trial sales of our electrolyte. So it was basically trial sales in single digit in crore terms. So not a very large from contribution point of view, but we are happy. This is the first quarter when the plant, even though it's not yet fully capitalized and not fully operational, but still we were able to get this kind of revenue from the part capacities which have come online. So that's a positive start on the battery. Overall, we have estimated this year it will contribute somewhere around 75 to 100 crore. But next year, when this capacity will be fully utilized, we see a revenue of at least 250 crores. On top of that, additional capacities, brownfield expansion, which we are undertaking this year, as they get approved, they will contribute. And also our greenfield site, which is almost 10 times bigger, that also is coming online in next financial year. So next financial year, we'll see full contribution from the existing capacities, new brownfield capacities, as well as the greenfield. So it will be 250 crore plus the contribution of the new capacities which are coming online. Together, these capacities on full utilization can contribute almost 2,500 crores. So we'll keep a watch, how much we can do next year. But FY27 is when we'll have all the capacities available for the full year.
Okay, so when these capacities come on stream and, when it contributes to your revenues, I'm sure there's some amount of debt that you would be taking up as well, because I understand that you're expecting a debt of 1,500 crores over the next 3 years. Will that be the peak debt, or do you think that it could get higher than that?
So I think 1,500 crores is the total capex which we are doing, of which the debt component would be around 1,100, 1,200 crore. Including our working capital in the main business and some capex. 1,500 crore would be like the peak debt is what we are today seeing. I think we also kept an option to raise more equity if needed in the future. It can be in the form of either a strategic in our battery business or just raising more equity in Neogen if needed. So we'll keep a watch on the debt equity ratio depending on how well the battery business develops and depending on the business needs. But that seems to be the peak debt we are expecting, at least based on projections which we've seen now.
What will margins look like? Because on one hand, pricing is going to remain subdued. It may not recover even through the course of this year, but you are seeing increasing contribution from the battery business. So what would consolidated margins look like for you in FY25, FY26?
So on a full utilization basis, let me go back. Our base business of pharma agro, at least FY25, FY26, once the margins recover, we can be somewhere around 18% to 20% range once markets recover a bit. And the battery business, we have given EBITDA margins of around, basically it's ROC driven. So we are targeting a 20% ROC kind of margins there. But on the EBITDA basis, depending on price of lithium, it can be somewhere around 16, 17% on EBITDA. So that's basically the margin. So let's say on a full utilization basis, Neogen Chemicals, traditional business, including organolithium, can deliver on a good year 18, 20% kind of margins. Let's say on the lower side, around 16 to 18%, what we are seeing the trend in last 1 year. And the battery business, ROC basis around 20% plus. But on margins, maybe around 16% EBITDA is what we are expecting.
But that's on full utilization. So this year, you're not going to have full utilization. The revenue contribution is only going to be 7,500 crores. And even the base business is not going to go back to the optimum pricing. What can we expect for margins this year?
I think this year, again, the capacity is also not coming fully. So as we don't have full utilization, we don't also have all the full expenses also. So we are still targeting, let's say, 16 to 18%, 19% kind of, between 16 to 19% kind of a broader range, because this business is just starting up. It's a bit more difficult to predict, more accurate. Otherwise, normally I like to give plus or minus 1% range. But because of the uncertainty, I would like to basically maintain a 16 to 19% kind of EBITDA range for the current year.
Okay, we'll leave it at that. Thanks a lot for joining in and all the best for the quarters to come. Let's take a short break on that note. On the other side, we'll discuss the market fundamentals. Ashi Anand of IME Capital will be joining in. Stay tuned.
Much more expensive than they were 2 decades ago.
Discounting is high there, but their focus is squarely on the 125cc segment.
Now it is contributing 16% of incremental global GDP.
Now we are looking at exporting the steel that's made here in India.
Welcome to the first ever India Business Leader Awards.
Cars, two-wheelers and vehicles generally being manufactured today are much lower on emissions and much higher on safety.
India's technology industry has been at the forefront of cutting-edge innovation over the last 25 years.
It's the retail which is the driving force for the market right now.
Clearly, we have arrived on the global economic stage.
Great way to celebrate our own 25th year with new milestones being achieved on the Lal Street.
21 years of the Nifty from 1,000 to 10,000 today.
Sensex and Nifty hit a record high.
The Nifty rallying to a record high.
We invite you to join us as we persist in leading coverage of the pharmaceutical and healthcare domain, documenting India's expanding expertise in medicines.
25 years of excellence and unparalleled growth.
CNBC TV18, embarking on a quarter century of excellence. Finance Minister Nirmala Sitharaman is just a few hours away from marking a new record. The CNBC TV18 coverage of the Union Budget starts right now.
Hello and welcome to CNBC TV18 Motilal Oswal Budget Headquarters.
Investing.
Welcome back. Let's get a market conversation going. Ashi Anand from IME Capital is now with us, and he's here with us in the studio now. Ashi, we always start the discussion with your digital disruptors portfolio. 25% holding in Zomato. PB Fintech is up 21%. Well, you've got a new entrant, Ola Electric. Does that fit the criteria for digital disruption? Did you analyze it, and what were your thoughts?
So we have analyzed it, right? Okay. And we're actually a little confused on whether it really does fit or not, and I'll explain why. The core element of digital disruption is it's very important that there are very strong competitive barriers to entry. And you want the platforms that we're investing in, we want them to emerge as one of the dominant players. I think you don't yet have that answer when it comes to electric two-wheelers. What market shares are likely to be 3, 5, 7 years down the line? Ola Electric clearly has strengths. They do have a certain right to win. We don't, however, yet know whether that is established enough and how that, as Hero and Bajaj and TVS get their act together, what eventual market shares are likely to be and what profitability is likely to be. I think that is still uncertain.
Okay.
And that is the main reason why
So why not play it for 2 years, 3 years till competition picks up? Because today Ola is a dominant player.
The fund is structured as a quasi-private equity fund. Okay. We are looking at playing longer-term disproportionate returns that can get generated. Even as of right now, right, what is pricing going to be, what's profitability going to be in the near term for electric two-wheeler players? It's still very, very nascent stages. We may evaluate taking a small stake in it just to have it in the portfolio. But I think just generally the core element of the digital disruption portfolio is that very clear right to win, becoming a dominant player, being around for the next 5 years and having a profit pool which could be very, very large, which you can really enjoy.
Also at a time when the electric two-wheeler space itself is seeing some demand slowdown, right? So the broadening of the sector is something which is also being questioned right now, the widening of the sector. But I take your point entirely. Do you feel that, given the fact that Ola is discounting heavily, even at the moment, right, 25, 30,000 rupees, it would be a longer journey to profitability, because once they sort of take those discounts out, then perhaps it could be a bigger impact on demand. So I'm just trying to understand, in terms of a timeline, what are you looking at for profitability?
So that is essentially our concern, right? You don't have clarity around that. Okay. And what's happening is that with ICE two-wheelers moving towards EV, your entrenched players, the Bajajs, the Heroes, they cannot let new competition come in and really disrupt. You'd be willing to kind of play off profits, and they have cash flows to allow losses to happen on the EV for a sustained period of time. So we're not very clear how long it is going to take before the space turns profitable. And that is our main concern. We also we were okay investing in a Zomato, investing in a PB Fintech. At a time, they were losing big amounts of money, as in we launched our fund in Feb. When everyone was looking at the hundreds of crores of losses. But what we did have was a clear path to profitability. I'm sure Ola Electric also has it, but the moment we need an industry to stabilize before really taking big bets.
So since you spoke about Zomato, I just want to follow up there. I mean, you have 25% weightage, right, in that stock. And of course, it's done phenomenally well. But for someone
it's been a 5-bagger for us. We recently just crossed 5.
Yeah, and it was a leap of faith for a lot of people, right, because of the trajectory that Zomato has had. But now, if someone's missed out on this rally, is it too late?
We don't think so. So I think, but the main call is the moment you're now investing in a Zomato at 250 plus kind of levels, you need Blinkit to work, right? At about 50, 100, 150, just on the pure food delivery system, there was a tremendous amount of value that we were seeing. However, the moment it becomes at these kind of levels, you are now ascribing about 50% of value plus for Blinkit. And that is a space where competitive dynamics are still to kind of evolve. We clearly believe that Blinkit has very clear rights to win. We've discussed this in the channel as well. So we do expect that to work. But I think the moment it becomes 250, 260, Arguably, it has become a slightly more tough call. We don't like a 5x in the near term is probably extremely unlikely.
Okay. Since we are on the subject of this digital portfolio, any changes that you've made in the last 1 month, post the Q1 numbers, anything that stands out for you, any changes that you would recommend to your portfolio?
No, so it's positioned as a private equity
Correct.
fund.
So no changes.
It's really, really stable. I think the main changes we've had to make in the portfolio has happened more because of risk control.
Okay, so because of risk control, have you made changes?
So what happens is Zomato keeps going up above 25%. We have a 25% limit. So then we have to trim and move it towards other places.
Okay.
We've started adopting a bit more of a string of pearls approach. So there are certain companies where we may not be as convinced as of today, but clearly there is some interesting value coming in. So Ola Electric, for example, could be an example. So what we're looking at is possibly having small exposures to some of these companies. So you start tracking them that much closer. They come into the portfolio, and you can possibly increase weights as these companies evolve.
So in your microtrends PMS, right, very interesting names is what you have here. I mean, of course, we've spoken about Zomato. There's also PB Fintech. There is 361, which is really growing right now. In this whole financialization of savings space, there's a lot of companies as well. HDFC Asset Management, HDFC Life. What are the big trends that you notice over the next, say, 1 to 2 years? What stand out for you?
You know, financialization of savings is a decade. As in, I think it's the next 10, 20 years. It's a very clear structural kind of play.
But something like an HDFC Life has been frustrating for investors, right? Over the last 2-3 years has given you absolutely no return.
But there were specific reasons, right? So if you look at it, we actually didn't buy HDFC Life until a few months back.
Okay.
There was a very specific tax change that happened, right? Which fundamentally impacted growth. You had, for a certain period of time, there was going to be a year and a half when nothing was going to happen in this company. We basically waited for that whole base effect to go away. But fundamentally, if you're just looking at financialization of savings as a theme, be it insurance, be it capital, be it AMCs, be it wealth management firms, we're seeing very, very attractive growth here. What we are seeing away from are brokers. We're seeing away from pure demat players because we believe that retail participation in direct equities and especially in F&O has probably run well ahead of itself. You are seeing the regulator coming in and trying to make some changes to try to impact this. So you are seeing some kind of risk in those segments. We're staying away from that. But I think if you're looking at mutual funds, life insurance, all of this looks very comfortable to us.
And one more word on Titan, because it is, stock. I mean, you hold about 2% of Titan in one of your funds. It's facing competitive headwinds. Some of the smaller players are doing better. So why not look at some of these mid-cap companies which are growing faster in the jewelry space?
So just the way Microtrends is positioned, it's positioned as a large and mid-cap portfolio. We believe that we can deliver outperformance to the overall markets by taking concentrated exposures in certain microtrends while staying in the large and mid-cap space.
So why not trend?
So we are evaluating, right? I don't want to get into a specific company, specific thing or whatever, but we are evaluating. We are aware of Titan and the competitive dynamics having changed, etc. That said, we believe Titan remains a very, very strong franchise. There are some near-term headwinds, but we still see a very large headroom for growth, and we believe the market can support a number of players all doing well.
Okay, well, your fund does have a lot of businesses that have been ahead of the curve and are growing in this tech space. So congratulations on that. And thank you so much for coming into our studios today.
Thank you so much for having me.
Thank you. Enjoy Bombay.
Yeah, thanks.
Okay, well, on that note, let's do one thing. Let's take a quick commercial break. On the other side of the break, lots more coming up on the markets, on individual stocks. So don't go anywhere.
it's very important to have debates, and we've agreed with Fox on a date of September 4th. We've agreed with NBC, fairly full agreement subject to them, on September 10th. And we've agreed with ABC on September 25th. So we have those 3 dates, and those networks, they're very anxiously awaiting that date and those dates. So we have September 4th, September 10th, and September 25th. The other side has to agree to the terms. They may or may not agree. I don't know if they're going to agree. She hasn't done an interview. She can't do an interview. She's barely competent, and she can't do an interview. But I look forward to the debates because I think we have to set the record straight.
Asking me about the debate, and I'll tell you, I'm ready to debate Donald Trump. I have agreed to the previously agreed upon September 10th debate. He agreed to that previously. Now it appears he's backpedaling, but I'm ready, and I think.
Welcome back to Trading Hour on CNBC TV18. Well, for now, the market, just a quick word on it, is actually not bad. Look at that. I mean, you know, one would have thought that post the Hindenburg report and post all of the fear surrounding it, the market would have taken a hit. But no, there's a big bounce back that's happened at the moment. And a lot of stocks in focus. Hero MotoCorp comes out with their earnings tomorrow. Ahead of that, the stock is up and about, up almost about 2%. And then a lot of these winners are piling on their gains. So whether it's a Jubilant Food, whether it's an Inox Wind, whether it's Ola Electric, of course, has been an upper circuit all along. And then a couple of these other stocks like Hudco, etc., are doing pretty well. The entire PSU space has come back in a big way. Ircon, SAIL, GAIL, IRFC, all of them looking pretty good. So it's really a healthy looking market that we have on our hands. But Amara Raja Energy and Mobility has unveiled its Giga factory just outside Hyderabad. They've set up an investment of 9,500 crores. The company will build battery packs and lithium-ion cells for electric 2- and 3-wheelers. Our colleague Jude Sannett spoke to the management about these developments and what it means for the capacity, expansion and more. As we slip into a short break, listen in.
The facility we're in today is our pack facility that we've inaugurated the phase 1 of. This facility today houses about 1.5 gigawatt hour of pack manufacturing. And today we have our 2-wheeler and 3-wheeler lines up and running. And eventually this facility will house about 5 gigawatt hour of pack manufacturing. This facility, I think, is largely catered to light electric mobility, which we're very bullish on. We think that the trends of electrification in 2-wheeler and 3-wheeler, they may kind of, they may slow down at times, but mostly we don't believe that these segments are going to go backwards. I think the electrification route is clear. It's unidirectional. We are seeing a lot more, movement on the passenger vehicle side. Little less on the penetration numbers, but definitely we are quite bullish that India will adopt the EV story, especially because I think for our cost points, we're a very value vehicle minded country, and some of the brands that have come in and been able to crack, that price point and the kind of the features, it's definitely going to go up, and we feel that we're in a good position to capture that. Aethers, they have a huge amount of data and user experience that they have from all the bikes and the kilometers that they've traveled, the number of packs and cells they have already installed in the market. So a lot of that is going to be made available to us to exactly spec the type of cell that they feel is going to be most relevant to succeed in the Indian road conditions. And by the time we start manufacturing our cells here, I think we'll have a very good design and we'll be able to give that to Aether to start and many other 2-wheeler manufacturers. With Piaggio, we are working on, actually it's a pretty expansive relationship we have with them. We started about a couple of years ago. We started with packs and chargers, and now we're into, a second or third generation of pack, next generation of chargers just coming off our lines in a town called Diguvamagam in Andhra Pradesh. And what we've agreed today also is, in addition to this firm fixed business over the next few years, also localizing cells inside these packs is now on the anvil.
voters deserve to see the split screen that exists in this race on a debate stage. And so I'm ready. Let's go.
CNBC TV18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhatt.
India Business Hour live on YouTube at CNBC TV18 weeknights at 7 p.m.
Let's talk about the big heartbreak for India, and that is what happened as far as Vinesh Phogat is concerned. And you went and met her, you had a conversation with her. You know, while the post-mortem is underway on what happened, what could have been done differently, what went wrong, what wasn't done, and so on and so forth, from an athlete's perspective, from her perspective, and someone who's dealt with adversity and someone who's hit rock bottom and sort of risen up, what do you see her mental state at this point in time?
Obviously, she's devastated. I can fully empathize with her. I can't even imagine what she would be going through. You know, I had heartbreaks in my sports career, but you know what she's gone through, I can't even understand. I met her, but I didn't even know what to tell her.
What did she say to you?
No, I mean it was just general talk on on life, on how life can be unfair, and sport sometimes can be brutal.
Did she have an assessment of what went wrong?
Oh, we didn't even get into that. But I just went to
offer your
support to her and to be there for her, and I think that's what she needs at the moment, and I think the country must rally behind her to.
Stocks swing between losses and gains in a volatile trade. Realty and consumer durables are key gainers, while utilities and autos are big drags. It's the mid-caps that underperform.
Hindenburg Research, following its report on Adani, has now flagged issues to suggest the SEBI chief's complicity in the matter and cited this as the reason for the SEBI inaction. The SEBI chief, Madhabi Buch, responds firmly to the allegations and do others named as well, including Adani, 361 WAM and SEBI itself.
Jubilant FoodWorks fires up on delivering growth in a weak environment. Voltas climbs on heady sales in the warm summer, but Balkrishna Industries skids on challenges ahead, even as Sun TV feels the heat as ad and subscriber numbers dip.
Ola Electric jumps 20% in trade to hit the circuit breaker. The move follows gains of 17% on listing day and comes ahead of its e-bike reveal on the 15th of August.
CVC Capital Partners clinches a near 7,000 crore deal to buy out existing promoter Kedara Capital from affordable home loan player Aavas Financiers. They'll also make an open offer to minority shareholders. The stock jumps.
Hello and welcome to Halftime Report. I'm Ekta Batra and with me is Mangalam Malu. Well, today is turning out to be a day where we have seen quite a lot of volatility in terms of trade, but what we are seeing now is a recovery from the day's lows. So the Nifty is up around 200 odd points from the day's low at this point in time. We have the mid caps, which are not doing too badly at this point either. So the mid cap index is just about going to break into the green by the looks of it. So it's just about flattened out with just around a 35-point cut. Advanced decline ratio, let's see whether there's any any kind of improvement as the day goes along. It's currently on the declining side. So around 1:1 is currently where it stands. Let's see if there's any kind of significant crisscross that takes place. But otherwise, it's a lot about stocks. So we mentioned Ola Electric, Avas Financiers, Voltas, Jubilant FoodWorks, Zydus, just to name a few in terms of a buzzing number of stocks today. Hi, Mangal.
Hi, Ekta. Absolutely. It's all about stocks. A lot of them doing extremely well in today's trading session. But you know what's good about today's trading session so far is that dips have been bought into. The sort of uncertainty that there was over the weekend with regards to the Hindenburg allegations coming in on Adani, that has actually come by in terms, the street has taken note of that and, you know, put it behind its back as well. We've got clarifications from all parties, and we've seen the biggest barometer of that is the recovery that we've seen from the lows on all the Adani Group stocks itself. So the street is looking ahead. They've put forth all these uncertainties and allegations behind, and the mid-cap index too that has recovered. It's the HDFC Bank stock which is led from the front for the Nifty Bank as well as the Nifty itself. So all these stocks doing extremely well. The mid-cap index briefly went into the green as well. We're talking about a lot of these individual stocks. The biggest gainer right now in the F&O pack is Jubilant FoodWorks, a fresh 52-week high on that stock. And this is on account of a solid set of numbers that have come by. So if you just take a look at the Jubilant FoodWorks numbers, there are 5 major reasons why the stock is up around 10% right now as we speak. The first one is that, you know, even as the like-for-like growth came in at 3%, largely at the higher end of street expectations of 2 to 3%, delivery saw a growth of about 12%, and that's a positive. And in this environment where, you know, you have something like a Westlife which reported a 7% decline in same-store sales growth, Pizza Hut, KFC down anywhere between 6 to 9% in same-store sales growth. Burger King's the only one which reported about 3% positive same-store sales growth. This, on the base that Jubilant FoodWorks sits on, is a big positive. Second important reason is that even the reported numbers are not particularly bad. You know, on a standalone basis, the revenue above expectations, the EBITDA in line with expectations, the net profit as well, not too far away from street expectations of around 55 crores. They've reported around 52 odd crores as well. They've continued to add stores. So Domino's at around 34 stores versus expected 40-45 stores. And non-Domino's portfolio is doing extremely well as well, be it Hong's Kitchen or be it Popeyes, where they've added about 8 odd stores as well. Point number 4 would be that, you know, the non-Domino's part of the portfolio doing well, and the non-India part of the portfolio as well is doing well. Remember, same time, you know, last year they did not have the DP Eurasia business in their books, but now that is contributing about 400 crores to its revenues, with Domino's Turkey doing about double digits like-for-like growth, and the other brand, Coffee, COFFY, doing about 7-8% growth out there as well, slated to become the 3rd largest beverage player in that market itself. So all these factors working well for Jubilant FoodWorks, and it was a stock which was underperforming for a while now. So the street is now betting on this turning around, and as a result of which brokerages are positive too. That's a near 9% up move that we're seeing.
Okay, that's on Jubilant FoodWorks. But what about Honasa?
Well, Honasa reported a good set of numbers, but it's the near-term uncertainty which is keeping the stock under a little bit of pressure today. In terms of reported numbers, if you just look at Honasa, you know, 19% revenue growth far outbeats the others in the industry, with 25% volume growth as well. The EBITDA grew by about 58%, margins improving by 200 basis points, and the net profit growing by about 63% as well. What the street does not like is that there is near-term uncertainty on inventory rationalization because of the distribution revamp that the company is doing. They told us this morning that it would be close to around 150 basis points of their sales, and ad spends as well. You know, the street was betting on ad spends to reduce the proportion of sales as all the other brands, you know, scale up. But this time around, it's around 36%, and the company does not believe that it will go beyond, much beyond that 70 to 80 basis points over this year itself. But nevertheless, they will continue to hold 20% revenue growth and 150 basis points margin growth guidance. The key drivers for them, Mamaearth gaining market share, new products doing well at 9% of their sales, and the third one is offline, which is now around 2 lakh outlets is where the company reaches, has increased by about 30%, and that would also be one of the growth drivers for them going forward.
Okay, all right. Thanks very much for that. So that's on the entire retail/consumer space. But the other one that we're tracking is Voltas, which is surging today on the back of what was a strong set of Q1 numbers. Upasna is here with the details on what's driving the counter. Upasna.
Thanks so much for that. Voltas reported strong set of numbers in its Q1 FY25 above street estimates. Strong growth was mainly driven by the company's UCP segment, which is nearly 77% of the sales. EMPS segment also recovered sharply this quarter and turned positive. Now coming to revenues first, the revenues stood at 4,921 crores with an uptick of 47% on a YoY basis. EBITDA saw growth of nearly 1.3 times at 424 crore, leading to a sharp EBITDA margin expansion of 310 basis points at 8.6%. PAT stood at 335 crores with an uptick of nearly about 1.6 times. Now coming to company's key segment, first up is UCP segment, which was the key growth driver. As stated earlier, recorded a strong revenue growth of 51% on a YoY basis, and margins in this segment also expanded by 40 basis points at 8.6%. Company's EMPS segment turned positive and revenue growth was about 40% on a YoY basis and margins turned positive at 7%. And lastly, company's engineering products and services segment saw a revenue growth of about 13%, but margins declined by 100 basis points at 28% on a YoY basis. So all in all, strong set of numbers reported by Voltas in its Q1 FY25.
All right, that's about Voltas. Remember, the stock had been under pressure before the numbers, so an element of short covering playing out as well. Let's focus on some of these PSU stocks, which are witnessing a silent sell-off on the back of their first quarter performance. Hormaz is tracking them for us. Hormaz, a big up move is what we've seen in the PSU stocks in the past, but surreptitiously over the last month or so, these stocks have come off.
Indeed, and it is almost as if the street was anticipating that there might be some bit of anomalies when these numbers come out, because at a time when all these PSUs were going up and away, they were talked about almost every single day. But then during over this last 1 month, month and a half, when there has been this silent sell-off that has come in most of these PSU names, be it the likes of RVNL, Bharat Dynamics, Midhani, Ircon, all of them, if you see, have corrected anywhere between 20 to 30% from the record highs that they made in mid of July. And since then, these stocks have come off after that. Now, you start off with some of the numbers that were YOY decline, if you can say, because the estimates were very few. Bharat Dynamics is one of them. The profit was almost wiped out during the quarter. Revenue was down 36%. Margins, the EBITDA loss also widened on a year-on-year basis. Execution issues continue to hamper the company, and it is reflective in the stock price as well. Midhani was the other one that reported results over the weekend. Revenue was down 13%. The profit down 70%. The margins also saw contraction from almost 22% to almost down to 14% now at the end of this quarter, and that was another disappointing result. And that's kind of started off last week when these railway PSUs started reporting numbers, be it RVNL or Ircon. Even RVNL saw revenue declining almost 30%, profit was down 35%, margins were down to just 4.5% at the end of the quarter, and that stock has seen a surge of almost 300% this year, almost 200 to 300% this year itself. And therefore, but not all PSUs have had bad numbers. Cochin Shipyard is an outlier in all of these because the revenues here were up 62%, the profit was up nearly 80%, the margins also saw an expansion of almost 600 basis points on a year-on-year basis. But still, that stock too has corrected almost 30% from the record highs. On the valuation front, despite this correction that you have seen, they are still pretty expensive when you compare that to their 5-year averages. Look at RVNL, still trading at almost 59 times price to earnings on a 1-year forward basis, and a 5-year average is just 12 times. So it shows the kind of run-up that these stocks have seen. Even Bharat Dynamics at 39 times, 5-year average is almost 30 times. Another outlier here is Cochin Shipyard. Despite good results, trading at almost 51 times price to earnings on a 1-year forward. The 5-year average is just 14 times. And you are awaiting some more numbers from some stocks that have run up significantly. Mazagon Dock is one of them. That too has come off 15% from the record highs. HAL around 18% from the record highs. Both of them reporting numbers on the 14th. So we'll keep an eye out on both of these names, but then this silent sell-off in the PSUs is a thing to watch out for.
Absolutely. Point taken, Hormuz. There is definitely some shaving off of interest which has come in on a couple of these PSUs. But just talking about stocks which are seeing profit booking, just watch out for Zydus Life, because that stock came out with a very good set of numbers. It reacted positively to it, but it's seeing a downtick today. That's because the street probably is a little concerned about the valuations. The stock is up 80% on a year-to-date basis. The likes of CLSA has downgraded the stock today, post the numbers. That is because of the punchy valuations. We'll take a short break, but on the other side, we'll connect with the management of Morepen Labs to discuss their earnings. Stay tuned.
difficult times. It's a very, very, very difficult period for her. Sport is hard. It's very, very, very hard, and that's why, India must look at failure very differently. I think society on its whole looks down on failure in India, and I think it's high time that society and the youth of the country become more sporting in nature.
Well, you've mentioned trigger links, and that's quite an Welcome back. Well, let's talk about a couple of companies then which came out with numbers. Morepen Labs is on our radar today. Q1 was a good quarter for them with improvement in margins and a healthy revenue growth as well. The company has raised 200 crores via QIP earlier this month. To talk more about the business, we have Sushil Suri, who's the chairman and MD of Morepen Labs, joining in now. Mr. Suri, thank you very much for taking the time out. Thanks very much, for joining in. We'll start with your revenue, because that was a good double-digit growth that you showed this quarter. I wanted to understand that within that, the medical devices, it's a relatively new business for the company as compared to, say, your APIs. It was up 20% this quarter on a year-on-year basis. What led to this 20% growth in the quarter? If you could break it up for us in terms of the domestic market, the exports, which are the segments which are doing well, and is it sustainable?
Yes, I think you raised a nice question. Is it sustainable or not? That way I would say, Ekta, that this is an interesting model that we have a fixed base of customers who buy our strips regularly. Basically, in medical devices, we are into two businesses, primarily glucometers and BP monitor. So glucometer is like an annuity business. We keep installing the meters in the market, and when the customers buy meters, and of course for the lifetime they have to buy the strips. So it's an interesting model. So as we speak today, so we have 1.2 crore meters in the market. It's like 12 million meters in the market, which is almost 20 to 30% of the market. So those meters keep on adding the strips, and if we stop selling meters, so certainly the growth would stop, but we keep installing more and more meters. That is what is adding to the revenue. So even if we add 10% meters extra, so we get 20 to 25%, 30% returns. That is on the meter side. Second is the BP monitors. So BP monitor also has registered a good growth, around 21% growth. So this is an interesting model. And more importantly, is it sustainable? That way, I would say it's just the tip of the iceberg. The Indian medical devices market has just opened up. And as per the Investment India, Government of India portal, so this market is only $11 billion. It's 90,000 crore. It's just
so
a
that
small
point is taken. Just to get some figures out of the way, then medical devices is now what, 30% of your sales. So how much do you envisage? How much do you envisage it will probably grow to, and by when?
Slowly, this is certainly inching up. Last year it was 26%, now it is 30%, particularly this quarter it is 30%. So if it keeps growing at the same volume, I would say maybe in 3 years' time it will be around 40-45% of the business. But more important will be it's a long-term business wherein we do not see any ups and downs because we have a inherent customer base. It's not unlike in API, we have a B2B wherein every quarter we have to find customers and every quarter whether they will buy or not. But sugar testing is why you are diabetic, then you are diabetic for the rest of their life, most likely.
All right. What about margins? Because last 3 quarters, ever since it broke into that 11% mark, it's maintained above that. In fact, now as we speak, it's around 11.3%. So should we consider 11% as the base now going forward? And what are the upsides here?
Mangalam, you rightly guessed that this is the base now. And as we go forward, and as earlier said that once we have installed the meters, I keep on selling strips, we obviously make more money on the strips. So our margins are going to increase in the medical devices certainly. And BP monitor also, last year we started 100% manufacturing in India. Of course, we are manufacturing everything in India now, but BP monitor last year was a full swing. So our margins are increasing in BP monitor also, our EBITDA is increasing. And by the way, this quarter was the highest EBITDA ever in last 40 years, thanks to all our backward integration in medical devices. And in API business, there is some confusion that because of the China factor, last 2-3 years were badly affected. I would say worstly affected on the EBITDA because the prices were going high. But this year, because of the softening of prices in China, the API margin have also returned back. So this is a good news and we hope to sustain it. And the whole idea is that we keep on changing or evolving our product mix in such a way that the focus should be on the margins.
We take that point, Mr. Suri, while your EBITDA is at a historic high, what's also interesting is that it was only last year where your cash flow turned positive, cash flow from operations turned positive after 2 years of a lull. Even last year, EBITDA was 2 times your operating cash flow. And at the same time, the street is looking at your dividend payout, your receivables have increased, as have your payables, along with your inventory, etc. as well. So, one wants to understand this year, what is the kind of operating cash flow that you would make? What would be the net working capital days? And at the same time, what is the kind of dividend payout plan that you have?
I would like to say that certainly the cash flow is a very big, complicated game, that net cash flow from operation. For a mid-sized company like ours, we hadn't had any capital event for the longest time and we are a debt-free company. So our cash generation goes into working capital and capex both. So every year we do 40-50 crore rupees of capex, which is again going from the cash flow. So of course it is deducted from the operational cash flow. Second is the working capital. In working capital, of course, we have a normal working capital. There's no extra increase. Normal, typically 60 to 70 days for devices and 80 to 90 days for the API. So we are good to go there. The only difference is in last 2-3 years, when post-COVID, there was a more focus on the domestic market. And rightly so, the global markets were shut in a way. So we have seen that in the domestic market, the debtors are very high. And of course, the credit periods are high and the debtor serviceability is also very low. So we are now trying to cut it down. During this quarter, we have cut down the domestic sales to a little extent, just 8-9%. We are focusing more on the export. The debtors are less, profits are high. So domestic markets are again China based. So there is a lot of price fluctuations also. So we are trying to make these corrections. And certainly we are cash positive quarter on quarter. But now post this QIP, all our additional capex requirement would be met from the QIP funds, I would say. And the additional working capital would also be funded from there. So the operational cash flow would be much better utilized and much faster recovery and much faster turnaround than because earlier we were going very slow in all things.
Okay, all right. We're going to leave it on that note, Mr. Suri. Thanks very much for joining in and speaking with us. So that's Morepen Labs. Stock is doing well. It's up around 5% They're expecting the medical devices segment to grow to around 40 to 45% of sales. And API margins have improved due to the softening of prices in China. Well, we need to take a short break, but up next we'll go full tilt on the markets. Manish Hathi-Ramani of Deen Dayal Investments will join in with some trading calls. Of migraines, a trigger which results in a migraine. Can you just tell us what is the most common trigger that one comes across when it is when one gets a probable migraine?
The triggers are generally divided across three different groups. One is the physiological within the body triggers. Two is from the environment and lifestyle. And there are some triggers which are beyond control. The commonest trigger that we see in our part of the world is related to the weather conditions, the type of temperatures we have, the heat, humidity in most of the cities for almost 6 to 8 months of the year. And then again, you have lifestyle-related triggers, which are the habit of not having breakfast on a regular basis amongst most Indians, and school children having to leave so early for school, they really rush with just a glass of milk. They don't have a proper breakfast. Skipping meals, the fasting habits across different religions in the Indian subcontinent is responsible for throwing up a lot more migraines. And stress, where stress leads to lack of sleep, poor quality of sleep. And now, in modern day times, you find increased screen exposure. Computers have become an essential part of education, laptops, and the mobile phone. Mobiles are small screens. They induce a lot of stress and strain, which can be a trigger for migraine. And apart from this, certain changes in the body, for example, the fluctuating levels of estrogen, which happen during the menstrual cycle of a woman, leads to, is a trigger for more migraines in women that we encounter. So these are some of the triggers. And then you have foods which are different from the rest of the world. It is well publicized, well published all over that chocolates, cheese, and red wine are the commonest cause of trigger. But when you come to see it in practice, these are not the common items which are consumed by most Indians. Yes, of course, they are correct triggers: aging cheese, chocolates, and red wine. But we have different food items which have the fermented food items like idli, dosa, dhokla. These are items which can also give rise to migraine attacks. And then rarely you come across different triggers. Triggers are different across individuals who suffer from migraine. So they are not the same for everyone, and one has to be alert that triggers are not seen always and not easy to identify. In about 70 to 80% of patients with migraine, you can identify the trigger.
Welcome back. You're watching us here on Halftime Report. There's been a smart recovery from the lows for the market, the Nifty as well as the Nifty Bank, all of them doing extremely well. It's the Nifty Bank which has led the recovery. So let's talk about what are the stocks in the Nifty Bank which are contributing. We have HDFC Bank doing extremely well, up around 1%, but Axis and Kotak as well. The private sector banks doing well for the Nifty Bank to come off lows, and as a result of which the Nifty to recover as well. It's the mid caps which is a wee bit of a problem today. While it is off lows, it is still underperforming in the red. And if you look at the advanced decline ratio as well, right, while it has come closer to each other, these lines, we still have a little more stocks declining than the number of stocks which are advancing. So this, towards the second half of trade, is something that I'll be watching out for very, very closely. For the Nifty, on the way up, 24,544, which is the 20-day moving average, remains to be an important resistance on the way up. So let's see whether it goes ahead and crosses past that or not. On the Nifty itself, because we've recovered from the lows, the 24,300 put has been extremely active. Even the 24,400 put writers have been pretty active, telling you value around 24,250 to 24,300, there could be a firm amount of support for this index on the way up. Again, like I pointed out, 24,450, 24,550 could be a bit of a resistance, and that's what we've seen with the kind of call writing at 24,500 itself. A bunch of stocks that we're watching out for today, a lot of long positions added on Voltas and Jubilant FoodWorks. Both these stocks up 8 to 9% each. And we may see a GNFC exit F&O ban, while there is an outside chance of Sun TV entering F&O ban as well. With a big kind of cut that we've seen and a sharp surge in open interest, it may, towards the end of trade, breach that 95% mark as a percentage of market-wide position limits and may perhaps enter F&O ban. So keep an eye out on this one.
Okay, all right, Mangalam. Thanks very much for that. So that's on the entire F&O space. We have Manish Hathiramani of Deen Dayal Investments joining in on the show to discuss the technicals. Manish, hi, welcome to the show. Well, it's turning out to be a session where we've seen a recovery which has taken place from the intraday lows. The mid-cap index still a little tentative along with the advanced decline ratio. But overall, how would you approach today?
Good afternoon, Ekta and Mangalam. Well, I'm of the opinion that 24,000 to 24,05 is still continuing to remain the strong support. We really haven't had a decisive close below those levels. That's the reason I would not be all out bearish. Therefore, if I'm not all out bearish, I'm really looking out to buy this Nifty. Currently, I'm working with a 24,500 resistance. If we can get past that, I feel 24,800 should be a breeze.
Okay, all right. And what about stocks? How would you approach today's trade in terms of a stock perspective?
Well, I'm working with two buy calls on the heavyweight side. The first one is on Infosys for a target of 1825, stop loss of 1750. The stock has taken good support at 1700 levels with healthy volumes. We have the potential of making a U-turn from here with a favorable risk to reward. The second one continues to be HDFC Bank for a target of 1700, stop loss of 1630. While the bank Nifty has been sideways, this particular stock seems to be in a clear up direction. We have taken support at 1600 and turned from there.
All right, take that point. HDFC Bank as well as Infosys, both those stocks doing extremely well. In fact, the IT index is contributing on the way up right now. Manish, thank you as always for joining in with some insightful analysis on the frontline index as well as individual stocks. We'll take a short break. On the other side, we have the management of Mayur Uniquoters joining in to detail their first quarter numbers.
You have to remember that there are 15 to 20% of patients in whom triggers may not be easy to identify.
take to build India's largest